So let's start with the revision of our first chapter in discussion, which is cost of capital. Now, what is this chapter all about? Now, we saw earlier that in our subject, financial management, there are broadly three objectives to be achieved. What are the three objectives to be achieved? Financing decisions, financing decisions, investment decisions, and dividend decisions. Correct? Financing decisions are nothing but decisions relating to the fundraising activity. Correct or not? Yes. Investment decisions are nothing but decisions taken with respect to how these funds are deployed, whether I should invest my money in project A or in project B, which is better. These kind of decisions are taken in investment decision. And finally, there is something called as dividend decisions. So after the money is being deployed in projects and the company earns profit, it has to pay the debenture holders, the preference dividend, all these things it has to pay, and balance money, whatever is left with them, is belonging to whom? The equity shareholders. Now, whatever is the money that is pertaining to the equity shareholders, it is not necessary for the company to pay it immediately right now. So it can decide how much amount to pay to the equity shareholders now and how much amount to be retained for future purposes. Are you clear with this? And this decision is called as dividend decisions. And in this subject, each and every chapter goes on towards achieving any one of these three objectives. Now, in this context, this chapter, cost of capital, comes under the first objective, which is financing decision. So this chapter, cost of capital, goes on to achieve the objective of financing decisions. Now, sir, what is this financing decisions, or basically what is this chapter, cost of capital? Now, let me just give you an introduction here. Now, let us assume this is the balance sheet of a company. Now, obviously, a company, when they want money, there will be many sources of finance for the company. Yes. So, what will be the multiple sources of finance? The popular sources of finance for the company: equity share capital. Yes. Then preference share capital. Yes. Then debentures could be there. Yes. Or term loans could be there. Yes. And then even retained earnings, your whatever is the profit that the company has made till now, the accumulated profit that is not distributed as dividend, that is also a source of finance for the company. Yes. Now you tell me, each of these source of finance, now the company will not get free of cost. So each of these sources of finance will have some cost associated with that. So, and that is what we are going to study in this chapter, called as cost of capital. So the cost associated with each source of finance is only called as cost of capital. This is point number one, the basic introduction. Point number two, this cost of capital that we are seeing here is always a percentage. It is always a percentage. It is not an absolute amount. The cost of capital is always expressed as a percentage. Sir, why is it expressed as a percentage? Let me give you an example. Let us say there are two people. Mr. A and Mr. B. Correct? Now, both of them have gone to a bank and they have actually taken loan. Are you clear with this? Now, let us say Mr. A pays 10 rupees of interest. Correct? Let us say Mr. B pays 15 rupees of interest. Mr. A pays how much? 10 rupees of interest. Mr. B pays how much? 15 rupees of interest. Now, out of these two people, which one has a lower cost? Now you will say that Mr. A has lower cost. Why? Because he is paying only 10 rupees, whereas B is paying 15 rupees. Now, wait. Now let me add one more part to it. Now, let me also tell you how much was the loan amount. Mr. A took a loan of 100 rupees, while Mr. B took a loan of how much? Let's say 200 rupees. Now, technically speaking, the cost as a percentage for A is how much? He is paying 10 rupees for every 100 rupees that is being borrowed by him. Or in other words, Mr. A is incurring a cost of 10%. Whereas if you look at B, he is paying 15 rupees So in absolute amount, it might be more, but this 15 rupees is a cost pertaining to 200 rupees of the finance that he has got. So, or in other words, 15 upon 200, this is nothing but 7.5 percentage. So now you tell me who, A or B, which one of these two people has got the finance, which one of these two has a lower cost of capital? Obviously, now you will say Mr. B. Now, why am I introducing this concept? Why am I discussing this particular example? Very simple reason. Cost cannot be compared in absolute terms because the capital pertaining to which the cost is being given might be different. So that is why if you always establish cost as a percentage, it is readily comparable. Are you clear with this? And in this chapter, whenever we use the word cost of capital, it is always expressed in terms of percentage. Are you clear with this? This is number one. Then, now, before we get into the technicalities of this chapter, there is a prerequisite that you need to know. So, the prerequisite for this chapter, that is a pre-requirement to enter into this chapter, is a chapter called as time value of money. Time value of money. Now, in this marathon, I am not covering time value of money because time value of money is not a separate chapter mentioned in the institute study material. However, this time value of money, the basic concept, is being covered already in a separate video that has been uploaded in our channel. So you can watch that first and then come to this particular marathon. In case you have not attended my lecture before, then you watch the time value of money concept first and then you can just come to this, so that whatever we are discussing in this particular chapter will be mindful and you will be able to understand the logics easily. If you have already attended my regular lectures, then you can directly continue with this particular marathon. You can directly enter into this cost of capital lecture. Are you clear with this? So now let's get started. Let's get started. So now what we are saying here is every source of finance has a cost associated with it, right? So now if you see, different sources of finance that we just saw right now are debt, preference shares, equity, retained earnings, and predominantly these are the sources of finance. Now, the cost associated with debt is called as cost of debt, or in other words, it is properly known as KD. K stands for cost, D stands for debt. Are you clear with this? The cost associated with preference shares is called as KP. And the cost associated with equity shares is called as KE. And the cost associated with retained earnings is called as KR. Are you clear with this? So now, each of these sources of finance, if you see, they have some cost associated with them. And I told you the cost of capital, we are going to compute it as a percentage. So obviously, each source of capital is given a separate name. So KE for cost of equity, KP for cost of preference shares, KD for cost of debt, KR for cost of retained earnings, and so on. Are you clear with this? Popularly, these four are there. Then for term loan, it is called as KT. This is not there in the study material, but anyways, we will be doing a sum regarding this. Anyways, KT, T stands for what? Term loan. That's about it. I will explain what it is. It's all very simple, right? Now, we need to compute the cost associated with each sources of finance. Now, let us say a company has raised equity share capital of 10 crores, right? Preference share capital of, let's say, 6 crores and a debt of how much? Debentures of, let us say, 4 crores. So a total finance raised by the company is how much? 20 crores. Now, the cost associated with this 10 crores is called as KE, that is cost of equity. How to compute that we'll be seeing later. Now, the cost associated with 6 crores is called as KP, that is cost of preference shares. The cost associated with this 4 crores is called as KD, correct? That is cost of debentures. Now, a person says, look, I don't want all these breakup. Now, overall, you have raised how much? 20 crores. Out of this 20 crores, for 10 crores, there is one cost. For 6 crores, there is a different cost. For 4 crores, there is a different cost altogether. Now, I don't want all this breakup. For this entire 20 crores, you tell me what is your overall cost of capital, and that is called as KO. Overall cost of capital. How to compute, we have not entered into it. We will enter into it now. Are you clear with this? So these are certain terminologies that you need to understand before we get into revising this particular chapter. So KE stands for cost of equity. KP stands for cost of preference. KD stands for cost of debentures. KO stands for what? Overall cost of capital. Of course, I told you KR stands for cost of retained earnings and KT stands for cost of term loans. Every single thing logically we will be seeing. You need not mug up any formulas. If you want to learn this logically, first you need to know this concept of time value of money. I will link everything to that and automatically you can revise everything. Some students, what they do, they prepare one full they prepare one sheet and write all the formulas, they mug up and then they go to exam. It is not at all required. Definitely it is not at all required. You can, if you know the subject logically at any given point of time, you can do wonders. That's about it. Are you clear with this? Fine. So now this is about the introduction. So the combination of cost and weights of each source of finance is called as overall cost of capital. It is popularly known as weighted average cost of capital. How to compute this and all we will be seeing. So first we will enter into this chapter. We will be seeing the logic for every single formulas that is there. And then we will be doing 2 comprehensive questions, and with that the revision of this entire chapter will get over. Are you clear with this? Yes. So now, yes, the meaning of cost of capital, just now I just explained. You can just go through it once. Basically, cost of capital is always expressed as what? It is expressed as a percentage. And one more thing, this is the difference between accounts and finance. Now we are in financial management. In accounts, what you do, you record whatever you have paid, correct? So in accounts, what we do is, so if I am paying 5 rupees of dividend, if I am paying 6 rupees of dividend, only that will be considered as a cost. Whereas in financial management, there is a concept of opportunity cost, meaning what? The expectation of the shareholders, not just the shareholders, the expectation of the investors should also be considered as the cost for the company. Sir, what is this, sir? Why you are saying? Let us say there is a bank, okay, and there is a customer. Let us say there is a bank and there is a customer, correct? Now, let us say that this customer, he has placed some fixed deposit with the bank, correct? Now, this bank, what they are doing is they are paying interest. Let us say at the rate of 7%. Just an example. They are paying interest at the rate of 7%. Now, you tell me, from the viewpoint of the customer, this 7% is his return, correct or not? Because he is receiving it. And from the viewpoint of the bank, the same 7% will be considered as the cost. Are you clear with this? Yes. Or in other words, whatever is the return of the customer, or in this case, the investor, the person who has invested money is called as an investor. The popular name, the common name known for all these instruments is called as investor. So whatever is the return to the investor can be considered as the cost to company. Yes, are you clear with this? But this is subject to a few exceptions which we will be seeing as we enter into this chapter. But for the time being, you just remember this. So the return for the investor is actually the cost for the company, and based on this concept, we will actually be moving into this particular chapter. Now look at this. Now, determination of cost of capital. Now, in our time value of money concept itself, we have seen basically we were matching cash flows, cash inflows and outflows and all that. Let me just quickly walk you through this. The cost of any source of finance is expressed as percentage per annum. I told you why percentage makes sense and absolute figure doesn't make sense. We just saw that example of Mr. A and Mr. B with the bank loan. To calculate the cost, first of all, we need to identify the various cash flows. So when we are talking about cost of equity or cost of debentures or cost of preference shares, first you should identify what are all the cash flows associated with each of these instruments. Inflow received at the beginning. Yes. Now let us say I am raising debentures. I am raising money through debentures. So first is what? You will receive some money as the debenture capital from the investors, correct? So what is the overall inflow received that you need to determine? These are some ingredients that you have. Then outflows of interest, dividend, redemption amount, etc. So if you are raising money through debentures, every year you need to pay something called as interest. Yes, suppose if you're raising money through equity or equity shares or preference shares, every year you will be paying something called as dividend, correct? And of course, in case of redeemable preference shares, redeemable debentures and all, there will be something called as redemption amount. You have to repay back the money. So these are all some outflow of payments. So outflow of payments typically will consist of what? It will consist of your interest or dividend, and at the end of the period you will have to repay back the capital, which is called as redemption amount. Then inflow of tax benefits on interest and outflow of payment of dividend tax. Right now dividend tax is not there, it has been abolished. Tax benefit on interest, what it is, I will discuss in a few minutes from now. So now what you have the inflow followed by a series of outflow, correct? Yes, or technically this is nothing but, so if you look at this, let us say I have issued debentures worth 100 rupees, correct? So in the initial year I receive how much? 100 rupees. Every year, let us say I have to pay, every year I have to pay 10 percentage on this 100 as what? As my interest, and for a period of 5 years. So for the first 5 years, I will be having an outflow of 10, 10, 10, 10, and at the end of the fifth year I will not just pay the 10 rupees, but I will also have to repay what? I will also have to repay my entire principal. Are you clear with this? Let us assume that I am redeeming at a premium. So redemption can be at a par or a premium. We know that, right? It is in accounts, we have seen it. Yes. So this is going to be, let us assume that the redemption happens at 105 rupees. So now you have all the cash flows with you right now. Are you clear with this? Yes. So for the first year, the cash outflow will be 10 rupees, second year 10, third year 10, fourth year 10, fifth year 10, plus I will have to repay back my capital. In this case, we have assumed a premium also at 105 rupees. Correct or not? Yes. So now in our cash flow equation, we saw that the rate that equates your present value of inflow with your present value of outflow is called as what? Is called as your IRR. The rate at which my present value of inflow and my present value of outflow matches is called as IRR. Or in other words, the first year will be discounted at 1 plus R to the power 1. The second year will be discounted at 1 plus R to the power 2. Third year at 1 plus R to the power 3. Fourth year at 1 plus R to the power 4, and fifth year at 1 plus R to the power 5. Yes or not? So in this case, we have the inflows, we have the outflows, we just need to calculate R. How will you calculate R? Using that IRR, trial and error method, correct or not? You will take one trial, it will show a negative NPV. You will take one more trial, it will give you a positive NPV. Then you will interpolate the two and arrive at the rate, the internal rate of return. That rate in this chapter is called as cost. Are you clear with this? So now in this example, whatever I gave you, this was pertaining to what? A debt model, a debenture model. I just gave you an example. So here what we have is we have the inflows, we have the outflows. So whatever R that we need to find out, this rate is only called as what? This rate is only called as our cost of capital. In this case, it is called as KD, that is cost of debenture. If you do a similar thing, if all the cash flows are pertaining to equity shares, then it will be called as what? KE, cost of equity. If you are matching the cash flows of preference shares, then this R, the rate that you get, is called as cost of preference shares, KP. Are you clear with this? So basically, this is nothing but this IRR, whatever we have studied in the basic concepts, that IRR, if you match your inflows with your outflows, so whatever is the rate at which your inflows and outflows matches, or in other words, the rate that makes your NPV equal to 0 is actually IRR, and that IRR is only the respective cost of every source of finance in this chapter. Are you clear with this? So now just quickly read this. So thereafter, we can use trial and error method to arrive at the rate where the present value of outflows is equal to the present value of inflows, and this rate is basically called as IRR. In investment decisions, okay, in this chapter investment decisions, in a later chapter which we will be seeing capital budgeting, this IRR indicates income because we have an initial outflow followed by a series of inflow. In this cost of capital, IRR represents cost because here we have initial inflow. First we will receive money from whom? First we will receive money from the investor, followed by a series of payments. we will have to, every year we need to pay them interest, and finally we will also have to repay back the principal. So here, when you have an inflow followed by a series of outflow, whatever you get is actually called as a cost. And alternatively, we can use shortcut formulas. Sir, so in this chapter, you mean to say that for every component of finance, for every source of finance, so we should use IRR method to calculate the costs pertaining to KE, KD, KP, KO and all? Ideally, yes, but we also have something called as shortcut formulas which are mentioned. Though these shortcut formulas are easy to use, they only give an approximate answer and not the exact answer. And we will discuss about all these things in this particular chapter. Are you clear with this? So overall, in this chapter, what we are going to see, we are going to see the cost pertaining to each sources of finance, and finally the overall cost of capital, popularly known as weighted average cost of capital, or WACC. This is what we are going to see. And before we enter into this chapter, there are a few important points that we need to remember. First, securities can be issued at par or at discount or at premium. We know this. Yes. So now let us say I'm going to issue debentures. Debentures can be issued at 100 rupees, or at a discount, let's say 90 rupees, or at a premium, say 110 rupees, correct? These are some basics that we already know. Similarly, the redemption can also happen at par, discount or premium. It can also be redeemed at the same 100 rupees, or at the time of redemption, it is enough the company pays 90 rupees, that is redemption at discount, or at the time of redemption, the company has to pay more than the face value, that is, let us say 110 rupees premium. Are you clear with this? Or in other words, to put it simply, so the issue and the redemption can happen at par, discount or premium. Are you clear with this? Yes. Next, there is something called as flotation cost or issue cost. What do you mean by flotation cost or issue cost? Let us say the company wants to raise 1 crore rupees by way of issuing new equity shares. Now, for the company to issue this equity shares, so the moment they issue this entire 1 crore, that will not be automatically credited to the bank account. For this fund raising activity, there will be some costs incurred. There will be some cost associated with it. Sir, what could be the cost? Example, the company has to issue something called as prospectus. Yes, then they will have to pay something called as underwriter commission. Underwriter commission. Correct? There will be some issue related expenses. Are you clear with this? So basically, at the time when the company receives the money, it will receive not this entire 1 crore minus all this flotation cost. Are you clear with this? And in this chapter, we are matching cash flows, and the initial cash inflow will not be the entire issue value. It will not be the entire issue value. Some costs, issue cost or flotation cost, will be incurred by the company, which will have to be adjusted, and only the net proceeds will be received by the company. Or in other words, whatever is the issue value minus the flotation cost is called as net proceeds. Net proceeds means what? The net amount that the company receives in its bank account. Are you clear with this? These are the costs associated with the issue of new security. Always remember, only when I'm issuing new securities, I will be having flotation cost. Or to put it simple, in case of retained earnings, there is no concept of flotation cost. Are you clear with this? Why? Because the money is already with me. The money is already with me. So retained earnings is nothing but my past profits that I have accumulated, correct? Reserves and surplus. So there is no extra cost that I need to incur to receive this amount. It is already lying in my bank account. Are you clear with this? Fine. A few examples are brokerage, commission, underwriting expenses, etc. It should be noted that these costs apply only to new securities and not to existing securities. Flotation cost is an outflow and should be deducted from the issue price to arrive at net proceeds. So net proceeds means what? The net amount of cash inflow that I receive at the beginning of the period. Are you clear with this? Net proceeds means the issue price less the issue expenses. Issue expenses is called as flotation cost. If the issue price is not given, suppose in exam, the issue price is not given, then the students can assume it to be equal to the current market price. So this is given in your institute study material. So if the issue price is not given, then take the issue price as equal to current market price. Sir, how can you take this? Obviously, you will be able to raise money only that is equal to the current market price, correct? Suppose the company share is currently quoting at, let us say, 25 rupees. The face value is 10 rupees. The market value is 25 rupees, which means you can definitely issue this as at a premium of 15 rupees, correct? The company has a face value of which is 10 rupees and the market price is 25 rupees, correct? So now what will happen here? The 10 rupee share can be issued at 25 rupees. How do you know? Because readily in the market, people are ready to pay 25 rupees for this 10 rupee share, which means when the company is going for a fresh issue also, what they can do is they can actually raise it at 25 rupees, or in other words, 10 plus 15 they can have as a premium, correct? So if the issue price is not given, you take the current market price as the issue price. Are you clear with this? These are some ground rules that have been mentioned here. And if the issue expenses, flotation cost, if it is not given, then you can assume it to be equal to 0. Now, one more popular doubt that I get from students. Now, what happens? Let us say in this case, issue price is how much? 25 rupees. That is, every share is issued at 25. The price at which the issue is happening is called as issue price. Issue price is 25 rupees. Let us say the face value is rupees 10. Okay. Now, in this question, let us say in a particular question, they have given flotation cost has been given as, let us say, 5%. They have just mentioned 5%. Flotation cost is given as 5%. Now, many students have a confusion as to whether the flotation cost should be applied as a percentage on the issue price or as a percentage on face value. Now, this is again a controversial area. In the institute study material, certain sums they have applied the flotation cost as a percentage on issue price. In certain questions, they have applied this flotation cost on face value. Sir, what should I follow? You can follow any one of these two methods. That is, you can apply this flotation cost as a percentage of issue price or as a percentage of face value. But understand one thing, whichever you do, whichever method you do, you just write a note in exam saying that in the absence of information. What is the absence of information? They have just given flotation cost is 5%. On what is not mentioned. So you can just write down, in the absence of information, flotation cost is applied as a percentage on issue price, or it is applied on a percentage of face value, and do. So if you do it like this, for the given assumption, your answer is correct. If you don't write this assumption, then the institute can penalize you for this. So let's be very clear. Whenever you look at flotation cost, if they have mentioned it as a percentage on what is not given, you write a note stating your attention and do it. Now, in my opinion, ideally, logically speaking, flotation cost should be applied on the issue price only. If you ask me, I would say flotation cost should be a percentage on issue price. Why? Because I am raising how much rupees now? Every share I am raising how much? 25 rupees. So this flotation cost is actually incurred on the amount that I am actually raising only, no? So technically speaking, your flotation cost should be a percentage on your issue price, but in certain questions, institute has also applied this flotation cost on face value. So this has confused many students. So students have been asking me this doubt. So what you can do is you can either apply it on issue price or on face value. You just write a note for it and leave it there. Suppose in the exam they've clearly given flotation cost is 5% on issue price. Then they themselves have given it is on issue price. Then there is no question of writing note and all. You can automatically apply it on issue price. Or in the exam they've given it as 5% on face value. You apply it on face value. There is no question of writing a note because there is no doubt here. Are you clear with this? Yes. So now, concept of tax saving on interest. This is one more very important basic item in this particular chapter. What do you mean by this? Let me just give you an example. Let us say we have two companies, A Limited and B Limited. Now, EBIT stands for what? Earnings before interest and tax. For the two companies is going to be 100 rupees. Just an example. So both the companies are earning the same amount of profit, right? EBIT minus interest. Let us say A Limited has borrowed fully, hypothetical example. A Limited has borrowed full money from debenture channel, and for this they are paying a total interest cost of 30 rupees. Just an example. Okay. So let us say the A Limited has borrowed some money through the debt channel, the debenture channel, for which they are paying 30 rupees every year. Whereas B Limited, they have not raised money through debentures, but the same amount they are raising it through preference shares, let us assume. So minus interest, For A limited 30 rupees, for B limited no interest cost. So EBIT minus interest gives you what? Earnings before tax 70 and here it is 100, right? Now minus tax at the rate of, let us say, 30 percentage. Now tax is calculated on what? Earnings before interest. So 30 percentage on the 70 rupees, how much is that going to be? 21 rupees. Whereas for B limited, the tax will be 30 percentage on 100, it is going to be 30 rupees, correct? So you get what? Earnings after tax, you get how much? So 70 minus 21, you get 49, and here you get 100 minus 30, which is equal to 70. Now minus preference dividend. Now B limited has borrowed the same amount for which they also pay the same 30 rupees. But this 30 rupees is not interest. The 30 rupees is actually a dividend. So they pay dividend. Are you clear with this? Now A limited, do they have to pay any dividend? No. Why? They have actually borrowed money through the debt channel for which the cost is interest. Whereas B limited, they have borrowed the same amount on which they are paying 30 rupees, but they are paying it as dividend. So dividend has been reduced here as 30. Are you clear with this? So now the net profit available to equity shareholders. So whatever is the remaining amount, it is pertaining to whom? The equity shareholders, correct? So net profit available to equity shareholders is how much? A limited is 49, whereas for B limited, it is only 40 rupees. Now, the question here is, look, both the companies earned the same EBIT, correct? Both the companies raised money, the same amount of money on which the cost was 30 rupees here, 30 rupees there also. Both the companies were paying the same cost, but still if you see, A limited is making more profit, whereas B limited is making lesser profit. What is the reason for this? So what is the reason for more profit being reported by A limited, whereas relatively a lesser profit being reported by B limited? This is because of the tax savings available on interest as a source of finance. What is this, sir? What is this, sir? If you see, interest is a tax deductible expense. Interest is a tax deductible expense. Meaning what? Now this tax amount of 30 percentage is paid on what? On EBIT. So the base on which the tax is computed is what? The base on which the tax is computed is EBT, correct or not? Yes. Now, for the purpose of arriving EBT, my interest was allowed as a deduction, whereas my preference dividend was not allowed as a deduction. So here, in case of A limited, they need to pay a tax only on 70 rupees as a base, whereas B limited needs to pay tax on the entire 100 rupees. Are you clear with this? Or in other words, basically, the tax outflow of A limited was how much? 21 rupees. The tax outflow of B limited was how much? 30 rupees. Or in other words, A limited was able to save 7 rupees of tax. Are you clear with this? And that 9 rupees of tax. Correct? So 30 minus 21 is 9 rupees, and that savings has only resulted in 9 rupees of more profit for A limited. Are you clear with this? Or in other words, if you see here, this 9 rupees, what is this 9 rupees? So on this 30 rupees of interest that has been paid, the company need not pay any tax. Why? It was allowed as a deduction from the base on which tax got computed. Or in other words, if you see, this 9 rupees is nothing but interest amount into tax rate. Interest amount of 30 rupees into tax rate of how much? 30 percentage. Are you clear with this? This 30 is nothing but what? This 30 is nothing but interest amount, and this 30 percentage is nothing but tax rate. Are you clear with this? So now can I say, if I am raising money through the debenture channel, how much I have to incur? I will have to pay 30 rupees, but wait, parallelly, I am saving 9 rupees of cost, correct or not? Why? Because I am paying it as an interest, it is allowed for the purpose of income tax, and I can get some savings in tax. Or can I say, the net cost for me, if I raise money through the debenture mode, is 30 minus 9, correct or not? Yes. So this 30 is what? So this 30 is your interest, correct? 9, can I rewrite it as 30 into 30 percentage? We just saw it here. 30 into 30 percentage is only 9, or in other words, this is nothing but interest into tax rate, correct or not? Or in other words, this 30 is nothing but the interest amount. Yes, this is nothing but the interest amount, and this is nothing but the tax rate. This is nothing but the tax rate, or can I say the net cost associated with debentures is not interest amount. Can I say it is 30 into 1 minus 30 percentage, correct or not? I am taking 30 common here. I am taking 30 common here. 30 the whole into 1 minus 30 percentage. So what will you get here? So what will you get here? So 30 minus 30 percentage into 30. That is what is the meaning of this. Are you clear with this? Or in other words, can I say the net effective cost of interest is not interest amount, but interest into 1 minus t. In this case, it is going to be 30 rupees into 1 minus 0.3. So how much is this going to be? So 30 into 0.7, 21 rupees. Or in other words, we can say that I am paying 30 rupees. Parallelly, I am saving 9 rupees of tax. So the net cost for me is only 21. Are you clear with this? Whereas if I raise money through preference shares, it will be I need to pay this entire 30. There is no tax saving. So ideally speaking, you cannot compare this 30 with this 30. You can compare this net amount of 21 with this 30, and you can say, look, debt is always a cheaper source of finance as compared to preference shares. Are you clear with this? Are you clear with this? So that is why even when we are calculating, you will see KD is generally lesser than KE or KP. Are you clear with this? The cost of equity, the cost of debt is generally lesser than the cost of equity or cost of preference shares. The reason being, dividends are not allowed for the purpose of income tax, whereas interest is allowed for the purpose of income tax. Are you clear with this? Because interest is tax deductible expense, there is something called as tax savings on interest, and the effective cost of interest is only interest into 1 minus t. Are you clear with this? So every year I am paying 30 rupees, but parallelly I will be saving how much? 9 rupees. So 30 minus 9 net off is only 21 rupees. So if I am raising money through the debenture channel, I am incurring a net cost of only 21 rupees. How will you write this? Interest into 1 minus t. So every year my cash outflow will be how much? Interest into 1 minus t. Are you clear with this? And this is called the concept of tax saving on interest expense. The payment of interest to the debenture holders or lenders is allowed as an expense for tax purpose, for the purpose of tax determination. Hence, the interest paid to debenture holders saves the tax liability of the company, and savings in tax liability is also known as tax shield. That's why interest amount, if you see, the whatever amount that you pay as interest, that is not your actual cash flow. Interest into 1 minus t is only your cash flow. Why? Because you pay the interest, parallelly there is a reduction, there is a savings in your tax. So this net amount is only your effective outflow with respect to your debentures or with respect to your interest. Are you clear with this? These are some basic concepts. Now with this, let us get into the first area called as KD, cost of debt. Cost of debt. Now debt stands for what? In this case, debentures. Now broadly there are two types of debentures. What are the two types of debentures? Irredeemable debentures and redeemable debentures. Irredeemable debenture means what? So it need not be redeemed at all. So what will happen is the company will raise the money through this debenture channel, and lifelong they will have to keep paying interest. It need not be repaid at all. This concept is called as irredeemable debentures. Whereas redeemable debenture means what? So clearly the life of the debenture will be given in the question. You will say this debenture after 10 years it has to be repaid back. So for the 10 years you should keep it as a life and do all the calculation. So there are broadly two types of debenture instruments: irredeemable debentures and redeemable debentures. Now irredeemable debentures. Now what we need to do, very simple, we need to calculate KD, correct or not? Now recall the concept that we studied in time value of money chapter. Now in time value of money chapter, we saw that in case of sum of equal annual cash flow, what is the formula? Present value is equal to annual cash flow divided by discount rate. This is what we have seen, correct? We have derived all these things. annual cash flow divided by discount rate. If you have not seen the time value of money lecture, please see it once so that you will get crystal clear clarity on this area. So the present value of any particular instrument, the present value of anything, any particular instrument will be annual cash flow divided by discount rate. Every year, provided what? Every year you are paying the same amount. The cash flow is same. In case of debentures, every year it is going to be the same. Correct. Now, in this case, can I call the present value as net proceeds? Why? This is the amount of inflow that I'm going to get. Net proceeds stands for what? Net profit stands for the issue price minus all the flotation cost, correct? So can I say this is equal to annual cash flow divided by discount rate? What will be the annual cash outflow for the company? It will be interest into 1 minus t, correct or not? I am paying interest, but parallelly I am also saving tax. So interest into 1 minus t is my net cash outflow divided by discount rate. The rate that equates my inflow and outflow is only called as the cost that we saw right now, or nothing but in this case discount rate I can write it as KD. Are you clear with this? Are you clear with this? Or in other words, can we say KD is equal to interest into 1 minus t divided by net proceeds? Are you clear with this? And that is the formula given here. Very, very simple. You need not mug this up. This is all based on time value of money concept. Annual cash flow divided by discount rate, that is going to be your present value, or discount rate is nothing but your annual cash flow by present value. Or in other words, you can also think of it like this. So in the numerator you have what? So KD, the cost, is nothing but what I pay upon what I receive. You need to understand this chapter. Cost of capital is looked at from the perspective of company. So always remember, cost is always from the viewpoint of the person who is borrowing the finance, correct or not? So the company is only raising money through this particular source of finance. So from the viewpoint of company, KD is nothing but what they pay divided by what they receive. What they pay every year? Interest into 1 minus t. Why into 1 minus t? Parallelly, there is a tax saving upon what? Net proceeds. Net proceeds is what? The net cash inflow that they get. That is the issue price minus all the flotation costs. From the viewpoint of the company, we are matching cash flows. We are not talking about accounting terms. From the viewpoint of company, we are just matching the cash inflow with the outflow. So basically here, the annual outflow divided by the overall cash inflow. What I pay upon what I receive. This is the formula for what? This is the formula for irredeemable debentures. Are you clear with this? Very, very simple. KD stands for cost of debt after tax. I stands for annual interest payment. Here I is an amount. It's a rupees. Annual interest payment. NP stands for net proceeds and T stands for tax rate. And net proceeds means the issue price less issue expenses. If the issue price is not given, take the current market price. If issue expenses is not given, then which means there is no flotation cost. You can take it as 0. Are you clear with this? This is a standing principle for all the types of cost that we are going to see. Are you clear with this? The first one, in debentures, what is it? Irredeemable debentures we have seen. What is the formula? Interest into 1 minus t divided by net proceeds. What I pay upon what I receive. As simple as that. No need to mug up even a single thing here. Next. Now, certain debentures can be redeemable. Correct? Some debentures can be redeemable. Yes, if the life of the asset is given. Don't worry. All these things we will be seeing examples. We will be solving questions. 2 broad comprehensive questions we will be solving. Fine. First, I am just revising all the concepts, and then we will get into 2 numerical problems for this chapter, and we are done with this. 2 comprehensive problems. Now, redeemable debentures. What is the meaning of redeemable debentures? So it is, I raise the money now, and let us say after 5 years I need to repay it back. Correct? This is called as redeemable debentures. So let me just take an example. So example for redeemable debentures. Let me just take an example. Let us say the face value is 100. Okay. The issue price, let us say the issue price is 90, and let us say issue price is 90, and the redemption value, the value at which it is going to be redeemed, let us say is 110. That is, the face value of the debenture is how much? 100 rupees. Currently I am issuing it at a discount, that is 90 rupees, but I am redeeming it at a premium of 110 rupees. Correct? Let us assume that the life of this particular debentures is 5 years, and let us say the interest rate is 10% and the tax rate is equal to 30%. Now, we need to calculate what? We need to calculate KD. KD is nothing but the cost of debentures. Now I told you, cost is nothing but the rate that equates my present value of inflow with my present value of outflow, or in other words, IRR calculation we need to do. If you calculate IRR, that is going to be for this particular set of cash flows. If you calculate IRR, that is going to be your cost of debt. Are you clear with this? So now first what you need to do, prepare a cash flow equation. So the rate at which my inflow is equal to outflow. What is my inflow? So right now the issue price is how much? It is going to be 90 rupees. That is going to be my issue. Now in this case, let us say they have not given anything about flotation cost and all. So flotation cost is not at all there in this question. If flotation cost is not there, if flotation cost is there, you need to reduce that also and arrive at net proceeds. Are you clear with this? If it is not there, then you can take it as 0. You've seen this. So initially I receive how much? 90 rupees, correct? Now followed by series of outflows. Every year I need to pay interest. What is the interest amount? 10% on 100, 10 rupees, correct? Wait, but parallelly there is a tax saving. So 10 into 1 minus 0.3. I also save 3 rupees on this. Because I am paying an interest of 10 rupees, I am saving 3 rupees of tax. The net cost, the net interest cost is only 7 rupees, correct? Similarly, in the second year, so I don't know at what discount rate we need to calculate. Divided by 1 plus KD to the power 1, correct? Similarly, 10 into 1 minus 0.3 divided by 1 plus KD to the power 2. Like this it goes on, and in the last year what will be the cash outflow? 10 into 1 minus 0.3, that is 7 rupees of interest, plus I need to repay the entire what? I need to repay my entire capital at a premium, plus 110 divided by 1 plus KD to the power 5, right? 1 plus KD to the power 5. This is going to be my cash flow equation, right? So now the rate that equates my present value of inflow with my present value of outflow, or in other words, the rate that makes my NPV equal to 0 is called as the discount rate, IRR. In this case, that is going to be your cost of debt. Are you clear with this? So how you will do? First, you will take one trial. So detailedly we have discussed in the basic concepts chapter. So since this is a revision video, I am asking you to refer that. In detail we have done this. So now basically what we need to do, let us assume R is equal to 10%. So you might get one NPV, you will get a negative NPV example. So then you assume R is equal to 12%, you might get a positive NPV. So now the NPV that makes that the rate at which my NPV is equal to 0, that is your required rate of return. So you have one negative NPV, you have one positive NPV, you interpolate the two and you arrive at the exact KD, and that is called as the IRR technique, or it is also known as yield to maturity approach. So this yield to maturity approach can be done only when, so this IRR approach can be done only when you have this finite period. Are you clear with this? The yield to maturity approach, YTM approach, or the present value method, what you will do is cost of redeemable debt, KD, is calculated by discounting the relevant cash flows using the internal rate of return, or in other words, IRR calculation is only called as KD in case they have asked you to do it as per YTM approach, also known as present value method. Are you clear with this? Are you clear with this? You just need to identify the cash flows and the rate that equates these cash flows, or in other words, the rate that makes my NPV equal to 0 is actually the required discount rate, or it is nothing but my KD. Are you clear with this? And this is what we need to do here. Clear with this? Yes. Now, sir, now every time, so this is just one source of finance, debt. Similarly for preference shares, similarly for equity shares, for every single source of finance, IRR computation we need to keep doing, we need to just keep on doing, then it will take a lot of time. Yes, that is why there is a shortcut formula method. There is something called as a formula method. Now this formula method, sir, is it correct? It is not precisely correct, but it is approximate. It is approximate because till date for IRR there is no formula. IRR has to be done only through the trial and error method. Using interpolation you arrive at the answer. But here there is something called as formula method, which is generally used for academic and examination purpose. Clear with this? Because in real life IRR can be calculated in a fraction of seconds. You have so many tools. Even in Excel you can calculate IRR and all. But in exam, since you might not be having all the time, there is an alternative method called as formula method. What they are saying now, this formula method, is it exactly correct? No, it is not exactly correct. The reason is it ignores the concept of time value of money. I will explain this quickly. Fine. So now, what is the formula for KD? I into 1 minus T plus RV minus NP by N, the whole by RV plus NP by 2. Sir, what is this formula? What have they mentioned here? Now, first, let us take our example. And with this example, I will explain the formula. Please don't mug it up. It is 100% logical, and I will also tell you what makes this particular formula illogical. That also I will tell you. So first, so what they have given, what is the interest? Every year they pay an interest of how much? Every year they need to pay an interest of 10 rupees. Yes, and into 1 minus T. So there will be a tax saving parallelly. So every year if you see, so I into 1 minus T. So 10 into 1 minus 0.3, correct? Yes, plus RV minus NP the whole by N. RV is what? Redemption value. How much is the redemption value? 110 rupees. 110. RV minus NP. How much is the NP? NP is the net proceeds. Today I am receiving how much? 90 rupees. Correct? The whole divided by N. So what is the life of this particular debenture? It's going to be 5 years. Correct? The whole by RV plus NP by 2. 110 plus 90 divided by 2. Sir, what is this formula? Simple. The same concept. In the numerator, you have what you pay, what the company pays. In the denominator, you will have what you receive. So what I pay upon what I receive. Sir, what are you saying about this? Fine. Let me just explain. This interest 10 into 1 minus 0.3. You understood this, correct? This is nothing but your an annual interest cash flow, annual interest outflow. Every year I am paying 10 rupees. Parallelly, I am saving 30% on that. So net off, it's only 70% on 10. 7 rupees is my interest outflow. Correct or not? Yes. Now, what is this RV minus NP by N? Is this also a cost? Yes. What is it, sir? How is it a cost? They are saying they are redeeming it. The company is going to redeem the debentures by paying 110 rupees. But initially, they have received how much? 90 rupees. So, they issued. At the time they received money from the investors, initially they received how much? 90 rupees. But when they have to repay, they have to repay how much? 110 rupees. Or technically speaking, they are paying how much more? They are paying 20 rupees more. Correct or not? They have received 90, but they are going to repay 110. So this 20 rupees they are paying more. Correct or not? Yes, but wait. So can I say this 20 rupees is a cost for the company? Yes, but this 20 rupees is a cost pertaining to this 5 years. Correct? Because this 20 rupees has to be written off over the life of the asset. Correct? This is not a cost incurred every year. It is a cost incurred for the overall life of the asset. So that's why we are doing RV minus NP. This is the overall extra amount that I am paying out of my pocket divided by N, divided by 5. So technically speaking, every year I will be amortizing 4 rupees towards that extra premium that I'm paying them. Are you clear with this? So this is also one more cost. So this cost is nothing but my interest cost. This cost is nothing but the extra amount that I pay to my investors. Are you clear with this? Divided by, so now divided by what? The debenture capital amount. Now you have two figures here. You have one something called as redemption value. You have something called as net proceeds. So now basically, so in the denominator, what you should have? The debenture capital amount. Correct? Now the problem here is, see, I receive 90 rupees, but I pay 110 rupees. Are you clear with this? So should I take this initial amount or should I take the final amount of redemption? Very simple. Take a simple average of both. So 90 plus 110 upon 2, and that is the denominator that we have got. Are you clear with this? So look at it component wise. You need not mug up anything. I into 1 minus T. What is I into 1 minus T? Annual, your interest outflow net of taxes, plus RV minus NP whole by N. What is this? The extra amount I pay, but this is for the entire year. So annually, how much is it going to be? Divided by the useful life of the asset. The whole divided by RV plus NP by 2. Which capital to take? I don't know. Take a simple average of the issue price as well as your redemption value and net it off. Issue price as in your net proceeds. Net proceeds is basically after adjusting for flotation cost, if any. Are you clear with this? That is about the logic. So now, Tell me what is the formula method for this particular KD calculation. I into 1 minus T plus RV minus NP, redemption value minus net profits, the whole by N, further divided by RV plus NP by 2. Very simple, very simple. Now, sir, why are you saying that this formula is also illogical? See, I gave you the logic for you to actually know the formula. This is the logic I told you. Why is the logic, why is this illogical? Let me tell you. Because this ignores time value of money concept. What are you saying, sir? How does it ignore time value of money concept? If you see here, redemption value is what? Redemption value is the value at which I am redeeming the debenture. That is 110 rupees. Net proceeds is the amount that I receive at the time of issue. Let us say in this case it is 90 rupees. Now you tell me, this 110 rupees is a cash flow arising at the end of year 5. This 90 rupees is a cash flow arising in T0, current present date. Now, without using time value of money, you tell me, are these two figures directly subtractable? Are these two figures directly comparable? Absolutely not. But in this particular formula, they have ignored the concept of time value of money and they have directly subtracted a 5th year cash outflow with the 1st year cash inflow. This is the problem that I said. This is the reason why it does not give the exact answer, but it ignores the concept of time value of money. But we have no other option to use this. Why? Because every time you cannot keep doing IRR in your exams. That's why institute themselves have given something called as a formula method, and they have made it very clear. Look, this is also given by the institute. You look at this. One second. Yes, alternatively, we can use shortcut formulas. Though these shortcut formulas are easy to use, they only give an approximate answer and not the exact answer. Are you clear with this? So institute themselves have given this formula method. They have told that in case of comprehensive problems, or in case they want to do they want you to do some questions, calculate KD, KP and all, you can use the formula approach also. Are you clear with this? So in case of redeemable debentures, you have two methods of doing. One is IRR. The other one is a shortcut formula. So how will you calculate KD? Using the shortcut formula, I into 1 minus T plus redemption value minus net profits by N, the whole divided by redemption value plus net profits by 2. Are you clear with this? See how logical it is, and students mug this up. If you spend some time in knowing the concept, you will thank yourself for a lifetime, because it will stay with you forever. You need not mug it up. Are you clear with this? And where I stands for interest payment, NP stands for net proceeds, RV redemption value, T is the tax rate, N is the remaining life of the debentures, the life of the debentures. Fine. And the same thing, it's also given here. Net proceeds means issue price minus flotation cost. In case issue price is not given, you can take the current market price. In case flotation cost is not given, take it as 0. As simple as that. Are you clear with this? Yes. Next. What is the next source of finance? You have something called as preference shares. Now, before this, let me also finish one more part, which is called as KT. So maybe you can just write this down somewhere. KT. KT. What do you mean by KT? Cost of term loan. Cost of term loan. So what is the cost of term loan? Now, very simple. In case of a term loan, there is no concept of issue price, redemption value, and all, nothing. So you will actually borrow some money, a principal from the company, correct? Principal from the bank. The only cost associated with respect to your loan is going to be your interest. Or in other words, unlike your debentures, RV minus NP, this will not have a difference at all. This is not at all a cost for you. Are you clear with this? So directly we can say, in case of term loans, the cost of term loans is nothing but interest rate into 1 minus T. The only cost associated with respect to my term loans is what? Interest. Let us say the interest rate is 10%. Correct? So I am paying 10%, that is my cost. But wait, on this 10%, I can also save some tax. So 10% into 1 minus 0.3, or in other words, this is going to be the net KT is going to be how much? 7%. Are you clear with this? So why this simple a formula in case of term loans? Because there is no concept of issue price, redemption value, and all these hangama in case of loans. In case of loans, principal has to be repaid. It cannot be repaid at discount, issued at par, nothing of that sort. principal, interest, that's about it. The only outflow, the only expense that you have, the only cost associated with term loan is going to be interest. Are you clear with this? So here it's going to be interest rate into 1 minus t, as simple as that. In case they are asking for cost of term loan, it's going to be interest rate into 1 minus t. Now let's go to the next one, which is cost of preference shares. Now tell me, in case of preference shares, what happens? So the company, if they are raising money through preference shares, they need to pay something called as dividend. And remember, dividend is not allowed for the purpose of income tax, which means there will not be any tax shield or tax savings on debentures. Correct? So now, in case of preference shares also, I'm sorry, I was talking about preference shares, not debentures. So there is no concept of tax saving on preference shares. No, in case of preference shares also, there can be two types. What are the two types? Irredeemable preference shares and redeemable preference shares. Irredeemable preference shares means what? So it doesn't have a finite life. It doesn't have a finite life. So you need to use the concept of what? Sum of infinite equal cash flows. Correct or not? The time value of money concept. In case of redeemable preference shares, yes, it has a finite life. Every year you will know the exact amount of dividend that will be paid. Correct or not? Yes, exact amount of dividend will be known in advance. Yes. So now, in case of irredeemable preference shares, what is going to be the formula? Exactly same as what we studied in KD. So KP is going to be what? So the PD upon P0. So what is this PD upon P0? PD stands for what? Preference dividend. And P0 stands for what? P0 stands for net proceeds from issue of preference share. That is, or in other words, what I pay upon what I receive. Whereas in case of debentures, what we saw, I into 1 minus t, interest amount into 1 minus t. Whereas preference dividend, there is no 1 minus t. Reason, there is no tax saving here. Are you clear with this? So can we say KP is equal to preference dividend divided by P0. P0 is nothing but the present value of your preference shares, or in other words, the current market price, or in other words, the net proceeds. Are you clear with this? Yes, are you clear with this? Very, very simple. The same logic you can apply here. So now same similar thing for net proceeds. So issue price less flotation cost. If the issue price is not given, take it as current market price. If the issue expenses are not given, take it as equal to 0. Are you clear with this? Yes. Next, cost of redeemable preference shares. Cost of redeemable preference shares. Again, two methods are there. The first method is IRR method. IRR method. So what will you do in IRR method? So initially I will receive something. Net proceeds is equal to, so preference dividend 1 plus preference dividend 2 plus preference dividend at the end of year 3, so on, so on, so on. Plus finally, let's say it is 4 years. Sorry, let's say it's 5 years. Preference dividend at the end of year 4 plus the redemption value. Correct? And every year I need to discount it. So you need to have every year's cash outflow and the first initial cash inflows. The rate that matches my inflows with the outflows is called as the discount rate, and in this case we call it as KP. Are you clear with this? And in case of preference shares, the preference dividend every year will be the same, or in other words, it is going to be what? It is going to be for a finite life. So what you can do, you can prepare a cash flow equation, and just like exactly like what we did for debentures, we need to do it here for preference shares. The only difference is what? There the annual cash flow was I into 1 minus t. Correct? Why 1 minus t? There was a parallel tax saving. Whereas in case of preference, there is no concept of tax saving. The annual cash flow will just be preference dividend. So here, every year, you will just be having the preference dividend amount as your cash outflow, and the rate that makes your net present value 0 here is called as your KP. Are you clear with this? Very, very simple. Now, alternatively, there is a formula approach. Yes, there is a formula approach. So what is the formula for that? Yes. So now in the numerator, you will have the cost. In the denominator, you will have the capital amount. Fine. In the denominator, the capital, what is it? RV or NP, take a simple average redemption value plus net proceeds upon 2. Correct? Very simple. Now, in case of numerator, now first, what is the cost? Every year I need to pay something called as preference dividend. Correct? Preference dividend every year has to be paid. Preference dividend plus RV minus NP the whole by N. Let us say it is redeemed at a premium of 110 rupees, but I'm issuing it at a par of 100 rupees. So overall for the life of the asset, life of this particular instrument is 10 years. So can we say, and every year I am paying a dividend of 9 rupees. Can we say that, look, I have to redeem it. At the time of redemption, I need to pay 110 rupees, but at the time of issue, I received only 100. Overall, for this entire life of the debenture, I have paid how much? 10 rupees more. So annually, 10 upon 10. So every year, my annual amortized cost is how much? 1 rupee pertaining to that extra amount that I am repaying. Plus every year I'm also paying this 9 rupees of preference dividend. Correct. So in the numerator, I have this 9 plus 1 divided by denominator. What will I have? Should I take the issue value or should I take the redemption value? There is always a doubt. Take a simple average. Redemption value plus net proceeds upon 2. Are you clear with this? Exactly same as your KD formula. Only difference is there I into 1 minus t came. Here that is simply preference dividend. 1 minus t will not come. Reason being that preference dividend is not eligible for income tax deduction. Are you clear with this? And that's about it. That's about it. Are you clear with this? Yes. So now let's move into the next source of finance, which is equity. So cost of equity. Now, in case of cost of equity, so equity is a very unique instrument. Sir, what is unique about this? Now, in case of preference and in case of debentures, the amount that they have to pay as interest or dividend is known in advance. That is, there is a fixed payout every year. Whereas in case of equity, there is no obligation on part of the company to pay a fixed dividend, or at times they need not even pay any dividend at all. So there is one aspect that is unique. This is one aspect that is unique about equity. That is, there is no contractual obligation on part of the company to pay any dividend. Are you clear with this? And number two, as we all know, equity doesn't have any finite life. There is no finite life in case of equity. Are you clear with this? So there is no finite life in case of equity. These are the two unique characteristics of equity, because of which to compute cost of equity, there are different methods by itself. Are you clear with this? So these two are unique characteristics of equity. What are the two unique characteristics? Number one, there is no contractual obligation on part of the company to pay any dividend. 1 year if they want, they can pay dividend. Another year, for the next 2-3 years, they need not pay any dividend. And later on, from the 5th year, they can continue paying dividend and so on. Are you clear? There is no contractual obligation to pay dividend. And number two, in case of equity instruments, there is no finite life. Obviously, there is no question of redeemable or irredeemable equity. No, in case of equity share capital, so the shareholders will get back their money only when the company is winding up. Are you clear with this? So during the life of the company, the equity shareholders are not paid back. Are you clear with this? Yes, of course. There is parallelly a secondary market. There is a secondary market. So in the secondary market, so you would have heard some people, they trade in shares and all. Yes, in their demat account. So in this NSE or BSE, they can trade and they can sell the shares, but that is in a secondary market. That is, there will be a buyer and you will be the seller. But the company anyways is not going to repay anyone. Are you clear with this? So the company is not going to redeem back. From the viewpoint of company, equity shares stays with them forever till the time of dissolution. Are you clear with this? Yes. Now, because of all these things, because of these unique features, there is not a single method to calculate cost of equity, but we have multiple approaches. We have multiple approaches. So broadly, there are 5 methods to compute the cost of equity: dividend price model, earning price model, growth model, popularly known as Gordon's model, under Gordon's model, dividend growth approach, earnings growth approach. There are 2 approaches. Then there is something called as realized yield approach, and finally you have something called as CAPM method, capital asset pricing method. Broadly, there are 5 different methods to calculate equity. So let us see one by one, and once again, all these predominantly, these are all some time value of money concepts. Now let us see this particular, the first approach, dividend price approach. What is this method? What is this approach? In this approach, they are saying, the present value of equity, is nothing. The value of equity is nothing but the present value of all the dividends received by the company, received by the shareholders. I'm repeating. So the present value of the shares, the present value of equity shares is nothing but present value of all the dividend received during the life of the particular equity asset. So what is this? What are they saying? Now, very simple. In case of sum of infinite cash flows, equal cash flows, what is the formula? Annual cash flow annual cash flow divided by discount rate, correct or not, gives you the present value of this particular instrument. Are you clear with this? So the present market price or the present value of equity share is nothing but dividend, annual dividend divided by KE, discount rate. Now when can you use this model? You can use this model only when the company pays constant dividend throughout the life of the throughout the life of the company. Are you clear with this? So in case of dividend price model, this is applicable only in case of constant dividend. If the same amount of dividend is paid for the entire life of the company, only then you can use this model. Sir, 1 year they are paying something, another year they are not paying at all. If this is the scenario, then you cannot use this model at all. So first, dividend price approach, when can you use it? When the dividend amount is equal for the entire life of the company. There is no life of this equity and all for this entire company. Are you clear with this? So what will be the formula to calculate the present value of our equity shares? Annual cash flow, that is dividend divided by discount rate KE, or if you cross multiply, KE is equal to D divided by P0, or in other words, D is nothing but annual dividend, P is nothing, P0 is nothing but the current market price, or you can even call it as net proceeds. So today, what is the value of the share? Are you clear with this? Yes, or in other ways, you can also remember this as what the company pays divided by what the company receives. So today, if they issue the shares, from now onwards, they need to pay dividend every year, and today they will receive this P0, present market price, they will be able to realize it. Are you clear with this? This concept is called as dividend price approach, and in this method, what they are saying, the value of equity can be derived by discounting all the dividend cash flows. Are you clear with this? That is called as dividend price approach. Now, the next approach is earnings price approach. It is exactly same as dividend price approach. Now, what they are saying, instead of discounting the dividend, what we need to do is we need to discount the earnings itself. Let us say the company has earned the earnings per share, let us say, is 10 rupees. For every share the company has earned, let us say 10 rupees. Now, out of this 10 rupees, the company has decided to pay 8 rupees to the shareholders as dividend per share, and 2 rupees per share they are deciding to retain it as their reserves. Now, you tell me, now the first method, what they are saying is only this 8 rupees is being considered, and they are discounting this 8 rupees to arrive at the present value of the share, correct or not? In this method, earnings price approach, they are saying no, not only this 8 rupees, even this 2 rupees also belongs to the shareholder, but the company has not paid, that's all, but this also belongs to the shareholder. So instead of using dividend as the parameter, take the earnings itself as the parameter, because the entire earnings belongs to the shareholder of the company. So now you tell me, in this case, what they are saying, the present value of the dividend, the present value of the equity is nothing but annual cash flow, that is earnings per share divided by what? So earnings per share divided by discount rate, which is KE. Are you clear with this? Sum of infinite equal cash flows is annual cash flow divided by discount rate. If you cross multiply this, KE is equal to EPS divided by P0. Are you clear with this? So when can we use this formula? We can use this formula when the company makes the same earnings every year throughout its life. Are you clear with this? Yes. So the first method is called as dividend price model. What is the formula? Dividend, DPS, dividend per share divided by P0, that is the present value of share. Next, in case of earnings price model, it's going to be EPS divided by P0. EPS stands for current earnings per share, and P stands for what? P0, or P stands for the market price per share. Are you clear with this? Now, the third approach is called as growth approach, also popularly known as Gordon's model. So what does Gordon's model say? In the basic concepts we have studied, Gordon's model, when we can use Gordon's model can be used when the cash flows will grow evenly over a period of years. That is, when there is a constant growth in the cash flows, then we can use this formula, then we can use this particular model called as Gordon's model. Now, the growth can be applied keeping your dividend as the base, or the growth can be applied keeping your earnings as the base, correct or not? So in the previous two methods, what we saw, constant dividend, constant earnings. Now we can see growing dividend and growing earnings. That does it make sense? Yes. So Gordon's model or the growth approach has two subdivisions inside it. What grows? Dividend growth approach, that is the first model. The second one is earnings growth approach, as simple as that. Now we have seen in the time value of money concept, we have seen in case of constant growth in cash flows, we have seen the present value is nothing but cash flow at the end of year 1 divided by discount rate minus growth rate. Yes or no? Sum of infinite growing cash flows geometric progression. Sum of infinite geometric progression series. We have seen this cash flow at the end of year 1 divided by discount rate minus growth rate. This is the formula that we have saw. This is the present value. Correct? So now in this case, you tell me. So P0 is equal to the cash flow at the end of year 1. In case of dividend growth model, D1, can I say D1 is nothing but dividend paid at the end of year 1 minus R, the discount rate stands for KE, divided by KE minus G. Or in other words, so if you cross multiply this, what will you get? So KE minus G is equal to D1 upon P0, or KE is equal to D1 by P0 plus G. Yes or no? We get this formula. Yes or no? So D1, KE is equal to D1 upon P0 plus G. Are you clear with this? So K is equal to D1 by P0 plus D. This is nothing but application of Gordon's formula. Sir, how did this formula come in? We've already seen in time value of money concept, sum of infinite growing cash flows in geometric progression. Are you clear with this? Yes. So now he's saying, now in this case, suppose they have given D1 is what? Dividend payable at the end of year 1. Sir, they have given only D0, that is the past dividend paid. Very simple. We know that past dividend D0 into 1 plus G gives you D1. That is, the past dividend into 1 plus growth rate will give you the dividend payable at the end of year 1. That is next expected dividend. Are you clear with this? P0 stands for the current market price and G stands for the constant growth rate of dividend. Are you clear with this? Now, in case of earnings growth approach, every single thing is the same. Instead of D1, you should use E1. So in case of earnings growth approach, replace D1 with E1. So in case of earnings growth approach, the formula will be K is equal to E1 by P0 plus G. Are you clear with this? E1 by P0 plus G. This is all based on the concept of time value of money that we have seen. So till now what we have seen? So dividend, so normal constant dividend model, that is dividend price approach. What is dividend price approach formula? So annual cash flow, that is dividend divided by annual dividend divided by what? P0, D divided by P0. Sir, here D1, D2, everything will be the same because the assumption is the same dividend gets paid for the entire life of the company. Are you clear with this? So D divided by P0, that is the first formula for dividend price approach. In case of earnings price approach, what is the formula? E divided by P0, that is what I pay divided by what I receive. Very simple. Next, in case of dividend growth model, what will be the formula? K is equal to D1 by P0 plus G. In case of earnings growth formula, the formula will be E1 by P0 plus T. Are you clear with this? As simple as that. That's about it. Next, in case there is a fourth method called as realized yield approach. So what is this? Now, this method is done from the viewpoint of investor. It is normally followed when the equity shares are sold by the equity shareholders after a few years. The KE is calculated by discounting the relevant cash flows using internal rate of return. Sir, what is the meaning of this? Now, just now we saw, a few minutes before, we saw that. Now, what is the return? From the viewpoint of the investor can be called, as the cost from the viewpoint of the company. Yes or no? So this particular formula is based on the assumption that the equity shareholders return is the cost of equity from the company's point of view. So how will we compute this? Now, let us just take a small example. I will just illustrate this, how this works out. Let us say Mr. A. What he does is, he purchases shares of, let us say, a company, ITC Limited. He purchases the shares of ITC Limited by paying 100 rupees, right? Now, after 5 years, he is going to sell the share for 105 rupees, right? And during the course of 5 years, he has received the dividend as follows: year 1, year 2, year 3, year 4, and year 5. So during the course of 5 years, he has received the dividend as follows. In the first year, he received 7 rupees dividend, second year 8 rupees dividend, third year 6 rupees dividend, fourth year 5 rupees dividend, and in the fifth year he has received 10 rupees dividend, some random dividend. Now what we can do is, in the first year he has actually paid 100 rupees to buy the share, correct? And what has happened in the T0, in the immediately current present day, he has paid 100 rupees to buy the share. Yes, fine. Now what he has done, during the course of the 5 years, he has received the following cash flow: 7, 8, 6, 5, and 10. And at the end of the fifth year, he has also got back his money by how much? 105. It has appreciated. He has got it back. 105 rupees. Who will pay? Company will pay? No, he has sold it in the secondary market. There is a ready share market, correct or not? There he has sold it and he has realized the 105 rupees. Now this, when he sells, some other investor will come and purchase it from him. The company is no way involved in transactions happening in the secondary market. Are you clear with this? So now you have framed the cash flows. So basically 1 plus ke to the power 1, 1 plus ke to the power 2, 1 plus ke to the power 3, 1 plus ke to the power 4, and 1 plus ke to the power 5. So ke here is the rate that equates my present value of cash outflow with my present value of cash inflow, or in other words, K is the rate that makes my NPV equal to 0. So using trial and error method, let K is equal to 10%, you calculate, you get a negative or positive NPV. Then let K is equal to 12 or 13%, again you get a positive or negative NPV. You can interpolate and you will get the answer. A typical IRR method, but whatever IRR you get, that is actually what? The return, that is the return for the shareholder. And in this case, they are taking an assumption that whatever is the return of the shareholder will be the cost from the viewpoint of the company. Now you read this. This method is done from the viewpoint of investor. But remember, this entire chapter is done from the viewpoint of the company. Are you clear? Cost means what? It cost is always from the person who raises the finance, and here the company only raises finance. But this method is done. This is normally followed when equity shares are sold by the equity shareholders after a few years. Now, from the perspective of equity shareholders, now they can buy today, sell it after 4 years or 5 years. From their viewpoint, it can have a finite life, correct or not? Yes. So what we are doing is, from the investor's viewpoint, you calculate the IRR, and that is only called as the KE from the viewpoint of company. Reason, the logic they are doing this is, they are saying that whatever is the return to the shareholder is assumed to be the cost from the viewpoint of the company. Are you clear with this? So the KE is calculated by discounting the relevant cash flows using the IRR model. So in case data is given from the investor perspective, can we still calculate KE? Yes, we can calculate KE. Nothing but IRR from the viewpoint of investor is the KE of the company. This is where I said, sir, here what the company has not actually paid anything, how can you call it? No, this is where I said KE and all this cost is expectation of return from the viewpoint of the investors. So the investors' expectation is only called as cost. Here we use the concept of opportunity cost and all. You need not actually pay dividend to actually, or you need not pay actually something to be calling it as a cost. Are you clear with this? This concept is called as opportunity cost, and this entire concept, this entire chapter is built around the concept of opportunity cost. So in this case, basically, if they have given you this particular approach, realized yield approach, things will be given from the viewpoint of the investors, and what you need to do is you just need to discount it, arrive at the cash flow equation, and find the IRR using the trials interpolation technique, and that is your KE. Are you clear with this? Yes. Now finally, there is one more thing, there is one more method called as CAPM, capital asset pricing model. So what is this model? First of all, understand this is actually a CA final concept. So in your intermediate, generally each of these ingredients of the formula will be given. You just need to plug the formula and write it down and arrive at KE. As simple as that. Still, I will give you the logic, but overall, if you see, this entire concept is covered in detail in your CA final. Now, what is this? K is equal to RF plus beta times Rm minus Rf. So this stands for beta. Okay, this stands for beta coefficient. K is your cost of equity. Rf stands for risk-free rate of return. Beta I told you. Rm stands for rate of return on market portfolio, and this Rm minus Rf is called as market risk premium. I'll tell you what this is. Now you have some money. Let's say you have some 100 rupees, right? Now, if you go and invest it in, if you open an FD in bank, now they will pay you 6% or 7%, correct or not? Yes. Now, why do you invest in equity market? Because you expect that the market will give a more return, yes or no? So that is the reason why you actually invest in the markets. Are you clear with this? Now, what is the flip side to this? When you invest in the market, you get more return, but you also have more risk, because you can also tend to lose money in the market. Yes or no? Fine. The risk is only given as beta. So beta coefficient is nothing but an indication of risk. How to calculate beta? It is a subject matter of discussion in CA final. It's a very big discussion. It's actually a statistical tool that you need to compute using standard deviation and all that. All that is not required right now. You just understand what it is. Beta and all will be given in the question. If this kind of question comes in, they will give you RF, beta and RM. So you can just plug the figures and do it, but you should know the reason for this formula. So what is the meaning of this formula? Let me just give you an example. Let us say if I invest money in my banks, let us say I will be getting 7%. This is called as risk-free rate of return. There is no risk. If you put some money in the bank, there is no risk. Or this can also be given in the question as GOI bond rate. GOI means what? Government of India. Government of India bond rate is 7%. If they give like this in the question, it means they are referring to the risk-free rate of return. Are you clear with this? Yes. Now, RM stands for the return that the market generates. Generally, the market, let us say, gives 12%. That's why people are willing to take the risk. Correct or not? Yes. Now, RM minus RF, if I do, RF is what? RF is risk-free rate of return. So tell me how much more than the risk-free rate of return is my market giving 12 minus 7. Can I say the market is willing to give me how much? 5% more as compared to my risk-free rate of return. Correct or not? And this is what the market generally gives. Now, every company has its own risk. If you see Tata Motors and if you take ITC, these two companies will be different in terms of risk. Are you clear with this? That risk coefficient is only given in terms of beta, and beta is generally a decimal. They will give it as 1.5 or 2, 2.5 or 2.4, 2.43, whatever it is. Now, beta denotes what? Risk. So basically what they are saying is cost of equity. Cost of equity is nothing but the cost from the viewpoint of the company or the return expectation from the viewpoint of the investor. So how much return will the investor expect? RF, 7% definitely he will expect, plus beta times RM minus RF. Let us say for this company, the beta is 2 times. So 2 times of 5%. What extra the generally market gives? Generally market gives 5% more. Since I am taking twice the risk, I want 2 times the market risk premium. The market risk premium means what? RM minus RF. That is the rate that the market gives in excess of the risk-free rate is called as RM minus RF. This is called as market risk premium. So into 5%. So technically, if you see, this is nothing but 7% plus 10%. It will be 17%. Are you clear with this? See, all the ingredients will be given in the question, but you just need to know the logic for this formula. You need not mug it up. So cost of equity in case of CAPM formula will be RF stands for risk-free rate of return, plus beta times RM minus RF. RM minus RF stands for market risk premium. How much extra the market gives as compared to the risk-free rate of return. Are you clear with this? And I want beta times that extra amount. Why? Because I am taking that much amount of risk. More the risk, more the return, and beta stands for risk. for intermediate, this level of understanding is definitely sufficient. How to calculate beta, statistical tools, standard deviation, all we will see it in final. Are you clear with this? Yes. So under the CAPM formula, so now what is going to CAPM method? So your K is equal to RF plus beta times RM minus RF. Are you clear with this? And with this, we have finished all the models. With this, we have finished all the models in this particular segment called as K. So what is the first model? K, dividend price approach. When will you use this model? When the company pays the same equal amount of dividend throughout its life. So now what will be the formula? KE is equal to D divided by P0, annual dividend divided by present value, present current market value, or you can also call it as net proceeds. Are you clear with this? Yes. Then your yes, earnings price approach. Here the formula is going to be E by P0, that is annual earnings divided by P0, that is the net proceeds or the present market price. Then dividend growth model, what will be the formula? D1 by P0 plus D. KE is equal to dividend by P0 plus D. This is derived from the sum of infinite growing cash flows of a geometric progression model, which we saw in our time value of money area. Yes, and then in case of earnings growth model, it is going to be E1 by P0 plus G. Are you clear with this? And then the fourth one, KE, that is realized yield method. Realized yield method is nothing but calculation of IRR from the investor's perspective when they can sell the shares in the secondary market. And finally, you have CAPM model wherein K is equal to RF plus beta times RM minus RF. And that's about it. So now let's move to the final one, KR, cost of retained earnings. Now, sir, retained earnings is something the company already has in its balance sheet. Sir, what is the cost associated with this? Wait. Now, this amount of retained earnings belongs to whom? It belongs to the equity shareholders. So, technically speaking, this retained earnings is also not free of cost because it has to be paid back to the shareholders at some point of time. Yes or no? Else no one will be interested in your company. You will not get new investors and all. So, technically speaking, the shareholders expect this amount also to be paid to them some way or the other. Yes, and hence, there is even a cost associated with what? Retained earnings. Very simple. KR is equal to KE. Are you clear with this? So cost of retained earnings is always equal to cost of equity. Are you clear with this? Yes, because it belongs to the equity shareholders, but this is subject to two exceptions. KR is equal to KE. This formula holds good always, except for two situations. And what are those two situations is what we are going to see right now. Are you clear with it? So let's see the two exceptions. KR is equal to KE. So KR is equal to KE, but there are two exceptions. Exception number one. What is the first exception? KR is equal to KE of existing equity share. Or in other words, KR is not equal to KE of a new equity share, that is a fresh issue of equity share. Sir, what are you saying, sir? Very simple. The only difference is while calculating the net proceeds, in case of calculating KE, what we do? Issue price minus flotation cost we do, correct or not? So technically speaking, flotation cost will arise only when the company goes for fresh issue of shares. Yes, in case of retained earnings, I told you at the beginning, there is no flotation cost and all incurred with respect to retained earnings. Why? The money is already in their bank account. Are you clear with this? Hence, that is why we are saying if there is any flotation cost given in the question, it should be ignored for the purpose of calculating KR. Are you clear with this? So, K is equal to KR? Yes. So, in case they have given flotation cost in the question, that flotation cost should be considered. With the flotation cost, you should find out KE, that is for KE calculation. Once again, you should calculate this KE calculation without this particular flotation cost, and that will be called as KR. Or in other words, KR is equal to KE calculation without considering what? Without considering your flotation cost. Are you clear with this? Why? Because this is not a fresh issue. This is an amount that the company already has with them. Are you clear with this? Yes. Exception number two. The second exception we are going to see right now. Now, this is actually, again, this is not a very good exception, but anyways. Now, in case in the question they have given, the personal income tax and personal brokerage of this particular investors. Now what we need to do is KE is equal to 1 minus tax rate, 1 minus tax rate, personal income tax rate of investor into 1 minus brokerage of investor. Sir, what is this? Now, KR is equal to KE. Yes. Suppose in the question they have given the personal income tax, not the company's income tax, personal income tax. They have given the personal brokerage and all. Now, the entire return they will not be able to enjoy. The entire, whatever is the KE is nothing but cost from the viewpoint of the company, return from the viewpoint of the investor. Correct? He will not be able to enjoy this entire return because there could be some tax. Correct? Let us say tax rate is 30%. So 1 minus 30, only 70% of this he can enjoy. But wait, there is one more thing called as brokerage. If you see in your demat account and all, if you want to buy and sell shares, you need to definitely pay some brokerage. That is also another cost. Let's say 5% is the brokerage. So basically on this KE, only 95% he gets, and on that also 70% goes by way of tax. I mean, 30% goes by way of tax, and only what you retain is 70%. Are you clear with this? So KE into 1 minus personal income tax rate into 1 minus brokerage. This is going to be your formula when the personal income tax and personal brokerage are given. Are you clear with this? So right now, so what is the formula for KR? KR is equal to KE. Two exceptions. Exception number 1. When the flotation cost is given, do not consider it for calculating KR. Number 2, when the personal income tax rate and brokerage rate of the investor is given, KR is equal to KE into 1 minus tax rate, personal income tax rate of the investor into 1 minus brokerage of the investor. Are you clear with this? In case these data is given, you can follow it. As simple as that. Fine. So now with this, we have learned each and every source of finance. We have learned the cost associated with each and every source of finance, KD, KP, KE, and KR. In fact, in KE only we had multiple models and all because of the uniqueness of that instrument, right? Now, individually, I have the cost associated with each source of finance. Let us say equity share capital is 20 lakhs. Fine. Your preference share capital is, let's say, 30 lakhs. Then your debentures is, let's say, 50 lakhs. Now, for equity share capital 20 lakhs, let us say KE is 10%, right? For preference share capital, let us say KE is 9%. For debentures, let us say the KD is going to be 7%. So let's say KE is 10%, KP is 7%, and your KD is equal to 7%. In this case, now overall, how much money the company has raised? They have raised 100 lakh rupees, correct? Now for this entire finance, for this entire 100 lakh rupees, now what is the overall cost of capital is what we are going to find out right now. So we will do this. We will learn this concept of weighted average cost of capital or overall cost of capital using a numerical example, right? So let's get started with a numerical example. So now let's solve the first problem, question number 1. So please take question number 1. Yes. So this is a comprehensive question where we will be calculating the cost of each components of finance, that is KE, KP, KD, all of this, KR, all of this we will compute, and finally we will also compute the overall cost of capital, KO. So here we will also see how to compute the overall cost of capital. I told you with this numerical example we will learn that as well. So let's get started. Let me read out the question for you. The following is the capital structure of a company. Equity shares at the rate of 100 each. The book value for that is 80 lakhs. Book value means what? The amount that is recorded in the books, that is lying in your balance sheet. Parallelly, there is a market value also. There is a ready market. Yes, as per the market, the value of this equity share is how much? 1 crore and 60 lakhs. Similarly, 9% cumulative preference shares, the rate of 100 each. Book value is 20 lakhs. The market value is given as 24 lakhs. 11% debentures, 60 lakhs and 66 lakhs. Retained earnings, 40 lakhs and nil. Now, very important. Sir, why for this retained earnings alone? In the book value, we have 40 lakhs, but in the market value, it is nil. Now, understand, this is very important. Now, equity shares, when I say equity, equity, not equity shares. When I say equity, equity generally means the amount that belongs to whom? The equity shareholders, correct? So the market considers 1.6 crores as the value of equity. That is, this 1.6 crores as a market value includes the value of equity share capital as well as of the retained earnings. Always remember this. When they give the market value of equity shares, basically it means that the market value of equity shares as well as the retained earnings has been considered, because separately for retained earnings you cannot have a market value. Are you clear with this? So basically in this case, this 1.6 crores considers the value of equity share capital as well as the value of retained earnings. This should be your understanding. Now, why we are taking this book value, market value, why we are doing all these things is, as we proceed into the question, automatically I will let you know, I will tell you what is this. There are two methods of computing the overall cost of capital. One is to the book value route, the other one is to the market value route. I will walk you through. Now, further data is given. The current market price of the company's equity share is 200. For the last year, the company has paid an equity dividend at the rate of 25%, and its dividend is likely to grow by 5% every year. So basically, why they have given all this data? So they have given this data to calculate KE using what? Dividend growth model. Under Gordon model, we saw dividend growth model and earnings growth model. In this case, we need to use dividend growth model to calculate KE. Then the corporate income tax rate is 30% and the shareholders personal income tax is 20%. Now shareholders personal income tax, why have they given? So generally KE is equal to KR. However, in case of two exceptions, we saw that KE will not be equal to KR. The first exception is what? KE will be equal, KR is equal to KE of the existing share capital, or in other words, if flotation cost is given in the question, that needs to be ignored for the purpose of computing KR. And number two, when the personal income tax and brokerage and all is given, KR will be equal to KE into 1 minus personal income tax into 1 minus brokerage. We saw all these things, correct or not? So for that reason, they have given. Then with respect to preference and debentures, nothing has been given. So life of debentures or life of preference shares is not given. So if the life is not given, assume it to be perpetual, that is irredeemable. So we will use the formulas of irredeemable debentures and irredeemable preference shares. Are you clear with this? Yes. So now what they have asked, you are required to calculate, number one, the cost of capital for each source of finance, that is KE, KP, KD and KR. We need to compute. Fine. Then the weighted average cost of capital, that is overall KO on the basis of book value weights, KO on the basis of market value weights. Now first let us do this segment 1. Segment 2 and segment 3 is very simple. Automatically you will understand. So let's get started. Now, sir, how do we know in this case KE? We saw that for KE calculation we had so many formulas, right? We had your constant dividend model, your constant earnings model, your dividend growth model, earnings growth model, CAPM model, yield model. So we had multiple models. Sir, how do I know which formula to use? You should know which formula to apply based on the data given in the question. In this case, they have clearly given the current market price, that is P0 is given for equity shares 200. Last year, the company paid a dividend of 25%, which means 25%, always remember dividend, interest and all is calculated on the par value, on the face value. So which means last year they have paid 25 rupees, 25% on 100. Last year the dividend paid was 25 and the dividend is likely to grow by 5% every year. So very clearly, by reading the words of the question, you can find out that this is a dividend growth model, and accordingly you should incorporate the dividend growth, that is the Gordon model, under the dividend you need to approach, you need to use. Are you clear with this? So what is the formula under Gordon's model? Recall this. So KE is equal to D1 by P0 plus D. All the derivations we have seen, correct? KE is equal to D1 by P0 plus D. D1 means what? Dividend at the end of year 1. Now look at this very carefully. Students make a mistake here. What have they given? For the last year, the company has paid an equity dividend at the rate of 25%, which means this 25% on 100, that is 25 rupees, is the dividend that was paid previously. This is D0. This is not D1. But we need to calculate D1, which means what? Dividend at the end of year 1. So how will you compute? They have given the growth rate also. They have said every year the dividend grows by how much? 5%. Last year they paid 25. So next year they will pay how much? 1 plus 0.05. So 25 into 1 plus G. Correct or not? Last year they had paid 25 rupees. Now the next year they will pay 5% more. Are you clear with this? So D1 will be equal to D0 into 1 plus G. That is last year dividend into 1 plus growth rate. So 25 into 1 plus 0.05. How did you get 25? This is 25% on the face value 100. They had given the dividend rate was 25% on the face value. So how much is this? So 25 into 1.05, it is going to be 26.25. Are you clear with this? So now you got this D1 value. So now incorporate all these things here. D1 is equal to 26.25. What is P0? P0 is the present market price. They have given this in the question, 200 rupees. So present market, you put it here. D1 by P0. P0 is 200 plus G. G is how much? 5%. So 26.25 upon 200 plus 0.05 gives you how much? 18.125%, and KE is equal to 18.125%. As simple as that. You should know. So in this case, what you need to know is, in this chapter basically, first, you should have a complete control over each of the formulas. How will you have control over each of the formulas? By knowing it conceptually. Don't mug up. Know it conceptually using the time value of money techniques. Predominantly, it is all based on time value of money techniques. And once you know that, especially for KE, KR and all, once you know that, then read the wordings given in the question and use the appropriate formula. Once you do that, life is simple. You can crack any kind of question in this chapter. You should have that much level of confidence. Next, calculation of KP. Now, look at this, KP. So now, what have they given? 9% cumulative preference shares at the rate of rupees 100 each. Now, in this question, life of the preference shares is not given. That is, they have not given what? They have not given the tenure or life of the preference shares. If tenure has not been given, you can definitely assume it to be irredeemable. You cannot say, I am assuming the life to be 10 years and all. You cannot do it. So if life is not given, assume it to be irredeemable preference shares. Correct? In case of irredeemable preference shares, so what is the formula? So KP is equal to PD, preference dividend divided by preference dividend divided by P0. That is the value of preference shares on the current date. Correct or not? So this is annual cash flow divided by what I pay upon what I receive. So this PO also is called as NP, net proceeds. Correct or not? Yes. So now you tell me, in this case, every year the company pays per share how much? 9% on 100 rupees. Correct? So 9 rupees they pay. Correct? Upon present value, or this is nothing but P0, the current market price or the net proceeds as on date. Have they given in the question? The current market price of the preference shares is not given in the question. If it is not given in the question, you can assume it to be as 100. So how can you assume? Because it's not given. So you will assume that the market price is quoting at 100 rupees or the net proceeds. If I issue today, I will issue it at 100 rupees only. I will be issuing it at par. So it's going to be 9 upon 100. So this is going to be 9%. As simple as that. As simple as that. So basically it is going to be KP is equal to preference dividend upon net proceeds or preference dividend upon P0. Fine. And this is going to be 9 upon 100, 9 upon 100, which is going to be 9%. Are you clear with this? As simple as that. This is an irredeemable model. How do we know it's irredeemable? Life of the preference shares is not given in the question. Look at this. That's why they have directly given. It is going to be 9%. Are you clear with this? Next. Your 11% debentures. Now, again, for debentures, you tell me, is there, have they given the life of the debentures when it is redeemable and all? Nothing is given, which means what? It is irredeemable debenture. So, irredeemable debentures, how will you calculate the KD formula? So, how will you calculate? KD is equal to interest into 1 minus T divided by net proceeds. Correct or not? What I pay divided by what I receive. From the viewpoint of company, every year I pay how much? Every year I pay 11 percentage. 11 percentage. So debentures face value is 100 rupees. If not given, we can definitely assume 100 rupees. Not a problem at all. So 11 percentage on 100 is 11 rupees. Correct? Into 1 minus T. What is the tax rate? Tax rate, corporate tax rate is 30 percentage. Don't take personal income tax, take corporate tax rate, because personal income tax is the tax rate applicable for the shareholders, that is used for calculating your KR, cost of retained earnings, whereas this corporate tax is used for calculating your KD. Fine. So 11 into 1 minus 0.3. Why do we do 1 minus 0.3 here? Because I will pay 11 rupees every year, but parallelly there is a savings of 30 percentage on that 11 rupees. So net of my cost is only 70 percentage on this 11 rupees. Are you clear with this? Divided by net proceeds. If I issue today, how much I will get? They have not mentioned anything. You assume it to be at the face value of 100 rupees. So now this is nothing but what? 11 into 0.3, which is 11 into 0.7 divided by 100. This is going to be nothing but 7.7 percentage. And look, that is what has been mentioned here. Interest into 1 minus T upon net proceeds. Upon net proceeds. Since the net proceeds is 100, they have directly applied it on percentage. You can also do this, or you follow whatever we have seen in the formulas. Are you clear with this? So 11 upon 100 into 1 minus 0.3, that's going to be 7.7 percentage. So this is what? This is also irredeemable debentures. Are you clear with this? Yes. So now we have calculated KE, we have calculated KP, we have calculated KD. Now let's go to retained earnings. Retained earnings, very simple. Always KR is equal to what? KE, correct? Yes, but wait, in this question, they have given personal income tax. I told you KR is always equal to KE. Two exceptions. Exception number one, KR is equal to KE of existing share capital, or in other words, in case in the question they have given you, this flotation cost and all, it needs to be ignored while computing your KR. Are you clear with this? That is number one. Number two, in case personal income tax or brokerage, or both personal income tax and brokerage is given, then KR is equal to KE into 1 minus personal income tax into 1 minus your brokerage. Are you clear with this? In this question, they have given personal income tax, brokerage is not given. Are you clear with this? So now, how will you calculate KR here? Very simple. KR is equal to, the base is KE, correct? KR is equal to KE into 1 minus brokerage rate into 1 minus personal income tax rate. So now you tell me how much is brokerage. So 18.125, this is your KE, into 1 minus brokerage. Brokerage is not there. 1 minus 0, it's 1. Into personal income tax is given as 1 minus 0.2. Are you clear with this? Is given as 0.2. So technically speaking, 18.125, correct? That should be the return that the equity shareholders should get, correct or not? Yes, but out of this, they need to pay 20% to the income tax department, which means technically they will receive only 80% of this particular KE. So 18.125 into 1 into 0.8, how much is that? 14.5%. Are you clear with this? So now we have got all the sources of finance, and we have got the cost for every component of finance. So here KE is equal to 18.125%. So I'll just write it down here. KE is equal to 18.125%. Then KP is equal to 9%. Remember, for KP, there is no tax shield and all. There is no tax saving because it is a dividend. Dividend is below the line item. Below the line means what? It comes after payment of your taxes. Are you clear with this? So it is not an expense allowable for the purpose of income tax. Then KD is equal to 7.7% and KR is equal to 14.5%. So these are the four sources of finance that we have got. Now we have computed what? The first part of the question, calculation of cost of capital for each source of finance. This is done. Next, part 2, weighted average cost of capital on the basis of book value weights. So what is this? Now, this is where we are going to calculate what? The weighted average cost of capital, overall cost of capital. First, we will do it under book value weights. I will explain what this is. Now, what are the different sources of finance? Equity, preference, debentures, retained earnings. We have four sources of finance, correct? Now, book values, that is, the values are given in the question: 80 lakhs, 20 lakhs, 60 lakhs, and 40 lakhs, correct? Just copy, paste and write these figures here. 80 lakhs, 20 lakhs, 60 lakhs, 40 lakhs. Yes. Then what is the cost for each source of finance? We just found out. Now only we found out. For KE, it is 18.125%. Correct. Then KP is 9%. We calculated this 9%. KD is 7.7% and retained earnings KR is 14.5%. Correct or not? Yes. Or in other words, can I say for 80 lakh rupees of capital, capital means generally a source of finance. For 80 lakh rupees of funds, the cost is 18.125. Correct. Then for the next 20 lakh rupees, the cost is 9%. Then for the next 60 lakhs, the cost is 7.7%. And for the balance 40 lakhs, the cost is 14.5%. Correct or not? This is the meaning that this is the meaning of the component wise cost that we saw. Overall, the company has raised how much? 200 lakhs or 2 crores. Correct. Now, I want to calculate. See, component wise, you told me for 80 lakhs, the cost is 18.125%, 20 lakhs, the cost is 9%, and so on. I want to know what is the overall cost of this 200 lakh rupees of capital. This is what I need to find out. Are you clear with this? So, how will we find out? Very simple. Very simple. Now, look at this. Look at this. 80 lakhs divided by 200 lakhs. How much is this? 80 divided by 200. How much is this? 0.4. This is the weight of equity. Correct or not? Yes. So, the weight of equity, the proportion of equity in the capital structure is how much? 0.4. Then similarly, 20 upon 200 lakhs, 20 divided by 200, how much is this? 0.1. The proportion of preference to the entire capital, the entire source of finance is how much? 0.1. Similarly, debentures is going to be 60 divided by 200 lakhs, which is going to be what? 0.3. And your retained earnings 40 divided by 200, it's going to be 0.2. So what we did was, we have calculated the component wise proportion, the proportion of every component of capital to the overall capital, that is 80 upon 200 is going to be 0.4. Correct. So equity is 40% of the total funds raised. Then your preference is 10% of the overall funds raised. Debentures is 30% of the overall funds raised, and retained earnings is 20% of the overall funds raised. Are you clear with this? Now we have the overall, we have the component wise cost. Do we have the component wise cost? Yes. We know that KE is equal to how much? 18.125%. Now, KE accounts to only 40% of the entire capital. Are you clear with this? So, what we will do is, we will multiply this weight with the respective cost. So, weight into cost will give you how much? 18.125 into 0.4. So, 18.125 into 0.4. How much is this? 7.25. Similarly, 9% is the cost of preference shares, but this accounts to only 0.1 of the total capital. So 0.1 into 9% gives you 0.9%. Similarly, 7.7% is what? The cost of debentures, but this accounts to only 30%, 0.3 of the overall capital. So 0.3 into 7.7, this gives you 2.31. And finally, you have KR of 14.5%, which accounts to 0.2, that is 20% of your overall capital. 0.2 into 14.5% gives you how much? So 14.5 into 0.2, that gives you 2.9%. Now you add up all these things, 7.25 plus 0.9 plus 2.31 plus 2.9, this gives you 13.36. So the overall cost of capital is how much? 13.36. That is, for 80 lakhs, the cost is 18.125%. For 20 lakhs, the cost is 9%. For 60 lakhs, the cost is 7.7%. For 40 lakhs, the cost is 14.5%. For overall 200 lakhs, the overall cost after averaging out is going to be 13.36. This 13.36 is what? The weighted average of each component of cost of capital. This is weighted to the weights of the proportion multiplied with the respective cost. And if you do this for this overall 200 lakhs, I will say the cost is 13.36%. Are you clear with this? So this weighted average cost of capital is very, very simple. What you need to do is, you need to arrive at the weights into your respective cost. If you just add it up, you get your overall cost of capital. Are you clear with this? Are you clear with this? Yes. Now this weights, in this case, what we did, this weights of 0.4, 0.1, 0.3, 0.2, we arrived using what? Book values. Correct or not? We arrived using book value weights. Yes. Now Alternatively, instead of using the book value to arrive at the weights, we can also use the market value to arrive at the weights. That's why they have given in the question, calculate the weighted average cost of capital taking book value as the weights, calculate the weighted average cost of capital taking the market value as the weights. So you can do it on either of the basis. So it is given in the question. Sir, if the question is silent, they have just asked us to calculate weighted average cost of capital, what you can do? You can do any of the two. You can either do it based on book value weights, you can either do it on market value base. Please write a note saying that this question has been solved using book value or market value weights, since the question is silent. Are you clear with this? As simple as that. But in this question, they have specifically given do it under book value as well as under market value. So once again, you need to redo the computation, this time under market value weights. Sir, then once again, should we calculate KE, KP, KD, KR? No. The cost components will not. The cost of the respective sources of finance will not change. Just the weights will change. So final answer will change. That's all. Each and every ingredient of cost will not change. Are you clear with this? So now look at this. Very interesting. So now again, list out the 4 sources of finance: equity, preference, debentures, and retained earnings. Are you clear with this? Yes. Now this is not book value. This is market value. Market value. So what is the market value given in the question? So go to the question. So 160 lakhs, 24 lakhs, 66 lakhs, and dash 0. Yes. So write down here 160 lakhs, 24 lakhs, 66 lakhs, 0. So this gives a total of how much? 250 lakhs. Are you clear with this? Now, look at this. The value of equity, the market value of equity includes what? The market value of equity share capital as well as retained earnings. That's why under retained earnings, we have put it as 0. Are you clear with this? Yes, because retained earnings is not separately computed here. So why? Because the market values equity as a whole. So they don't say market value of equity share capital, market value of retained earnings. They just call it as market value of equity, which means what? This is the overall market value for whatever is the amount that is owed to the equity shareholders. That's how the market values. Are you clear with this? So now what we have done, 160 lakhs, 24 lakhs, 66 lakhs and 0. Are you clear with this? There is an alternative way of doing this. Sir, what is the alternative way of doing this? So in this question, what they have done, 160 lakhs, 24 lakhs, 66 lakhs and 0. Correct? So let me just do it here. So in this question, what they have done, so they have taken equity, right, preference, then debentures, and then they have taken retained earnings. Correct? Now in this question, what they have done, market value, they have taken 160 lakhs, then 24 lakhs, then 66 lakhs, and then 0. They have taken total of how much? 250 lakhs. Correct or not? Yes, this is what they have done in the question. So the entire value of equity, market value of equity, was considered against what? Was considered against the equity share capital. Are you clear with this? Alternatively, what you can do is, instead of doing it like this, alternatively, you can also, there is one more method which is allowed as per the institute study material. So equity, preference, debentures and retained earnings. So there is no problem with respect to preference and debentures. It's going to be 24 lakhs and 66 lakhs respectively. Now go to the question. What have they given? They have given that 160 lakhs is the market value of equity, or in other words, this value includes the value of equity share capital as well as the value of retained earnings. Correct? So now there is another method where this market value can be apportioned between your equity share capital and your retained earnings using the book value proportion. Sir, what are you saying? That is, this 160 lakhs is the market value of equity. Correct? So we took it as the value of equity share capital and put retained earnings market value as 0. Correct? Or second method, alternatively, what you can do is take this 160 lakhs. Correct? This is the market value of equity share capital plus market value of retained earnings. What we can do is split this between the equity share capital and retained earnings in the ratio of 80:40. That is in the proportion of their book value. Are you clear with this? So basically, this 160 lakhs of equity is there, no? This 160 lakhs of equity, what we can do is we can distribute it distributed between the equity share capital and retained earnings in what ratio? In the ratio of book value, that is in the ratio of 80 is to 40, right? 80 is to 40, or this is nothing but 2 is to 1. Are you clear with this? 2 is to 1. You can actually divide it in this ratio. So 160 divided by 3 into 2. So how much is this going to be? So this is going to be 106.66667 lakhs, and this is going to be how much? This is going to be 53.3333 lakhs. Are you clear with this? So basically the market value of equity is being apportioned between the equity share capital and retained earnings in the ratio of their book value weights. Are you clear with this? So now here, instead of writing 160 against equity share capital and putting 0 against retained earnings, what you can do is you can write down 106.67 lakhs against the equity share capital, and you can write down 53.33 lakhs against the retained earnings. The total will not change. The total will be the same, 250 lakhs. Are you clear with this? So what we have done in the first method, the market value of equity was fully taken as the market value of equity share capital, and retained earnings was taken as 0. In the second method, what we can do, alternative method, is you can take the market value of equity and apportion it between the equity share capital and your retained earnings using its book value proportions in the ratio of 80 is to 40. Are you clear with this? In the ratio of 80 is to 40, in this case, it was what? 2 is to 1, correct or not? Yes, and in the ratio of 2 is to 1, if you split it, now you get the market value of equity share capital, you get the market value of retained earnings. So in this case, so the overall is going to be 250 lakhs, but the internal weights will change. Are you clear with this? So if I take this as weight, then RE, the retained earnings, will be 0. It will not be given any share of cost. Are you clear with this? And in this question, KR and KE is not the same. Why? Because of some personal income tax given in the question. So the answer will also change because of this. Yes, sir, then how will I know which method to follow? You can follow any of the method and the institute is fine with it. Are you clear with this? If you want, you split it. If you don't want, you don't split it. Put the entire value of equity against the equity share capital. Are you clear with this? Any which ways you can do. Sir, because of this, how will the answer change? The answer will change because the component wise proportions will change. Are you clear with this? And hence your weighted average cost of capital will also change accordingly. Yes, but this answer will not change if KE and KR are equal. If KE is equal to KR, then whatever you do, this answer will not change. But when KE is not equal to KR, then the answer will definitely change because of the method that you pick. Are you clear with this? Are you having clarity? An institute is fine with taking any of the methods because in certain sums they have used this method, in certain sums they have used this method. So any which ways you can do it. Are you clear with this? It is just a matter of calculating the weights, as simple as that. So now we've got 160, 24, 660. So the overall is going to be 250 lakhs. So 160 upon 250, how much is the weight? It's going to be 0.64. Then 24 upon 250, it's going to be 0.096. Then 66 upon 250, that's going to be 0.264, and retained earnings is going to be 0. Are you clear with this? Suppose if we do it in alternative 2, these two will remain the same, but the equity and retained earnings, the proportion will change, because of which the overall answer might change. Are you clear with this? So now cost of equity 18.125%, KP is 9%, KD is going to be 7.7%, retained earnings, since we have not taken anything, we have not given any share, we are putting it as 0. Are you clear with this? So you multiply the weights with the respective cost and you will get the overall cost of capital using market value weights. Are you clear with this? And remember, this is also alternative 1. Are you clear with this? Once again, if you want, you can also compute the weighted average cost of capital using the market value weights by using the alternative 2. What is alternative 2? Splitting the value of equity between equity share capital and retained earnings. Will the answer change? Yes, the answer will change, because in this case, KE is not equal to KR. KE and KR are having different values. So the proportion that each component gets will be different. Are you clear with this? And as simple as that, this is the overall concept of your weighted average cost of capital and all the components of your finance, that is KE, KD, KP, KR, and all these things. Are you clear with this? As simple as that. Get the logic, get a complete control of this particular chapter. First, what you need to do, component wise, learn how to calculate the cost of every component. KE, KD, KP, KR. You just know how to calculate all of this. Learn it logically. In case of KD and KP, there are two things, redeemable, irredeemable option, correct or not? Yes. So KD, KP, yes, there are redeemable and irredeemable option. That's about it. That's about it. Fine. And in case of redeemable option, you have further two formulas. One is IRR method. The other one is a shortcut method. Are you clear with this? Everything you learn it conceptually at any given point of time, whatever question they ask, you will be in a position to handle it. And once you compute the component wise cost, you either use the book values as the basis or the market value as the basis to arrive at the weights and calculate the weighted average cost of capital. And when the market value weights are given, always remember the market value will be given only for that equity share capital component. So there will not be a separate market value for retained earnings, because this 160 lakhs is the market value of equity, that is equity shares as well as the retained earnings. So method 1, keep this 160 lakhs while computing the market value weights. Take this 160 lakhs under equity share capital. This is alternative 1. Or alternative number 2, take this 160 lakhs and split it between the equity share capital and retained earnings, the ratio of 80:40, and you proceed with the question. Are you clear with this? And with this, we have finished the first question, which is question number 1. Clear with this? Yes. So now let's go to the next question. The next question is interesting, and we have an incremental learning also. We will see a concept called as weighted marginal cost of capital. What it is not, we will see. And apart from that, we will also see component wise cost calculation. So all of this we will be seeing in the next question. Now, question number 2. XYZ Limited has the following book value capital structure. Capital structure means what? Basically, the components of capital is called as capital structure. Equity capital in shares of 10 each, fully paid up at par, 15 crore rupees, right? Then 11% preference share capital in shares of rupees 100 each, fully paid up at par, 1 crore rupees. Retained earnings 20 crores, 13.5% debentures of 100 each, 10 crores, 15% term loans, 12.5 crores. So in this question, term loans is also there. So term loans, I told you it is KT, correct? Cost of term loans, very simple. It is interest rate into 1 minus T. There is no concept of redemption value, net proceeds and all. It is always principal repayment. That's about it. The only cost is your interest cost. We have seen all these things. Then one paragraph is given below. What for they have given this paragraph? Generally, they give this in this paragraph, they will give you a lot of hints to use the right method to apply the formula for KE, KD, KP calculation and all. Are you clear with this? The next expected dividend on equity shares per share is going to be 3.6. Read the words very carefully. Next expected dividend, which means what? D1 is going to be 3.6. The dividend per share is expected to grow at the rate of 7%. Very clear. And the present market price per share is 40. What method they are saying? This is for KE calculation under what? Dividend growth model. That is KE is equal to D1 by P0 plus G. D1 is there 3.6, P0 is 40 plus G 7%. That's all. One look at the question, you have calculated KE. As simple as that. Remember, this is not D0, this is D1. Why? Because they have given next expected dividend. Annual cash flow at the end of year 1. Are you clear? Cash flow at the end of year 1. That is what we saw in the time value of money concept. D1. Are you clear with this? And this D1 figure is ready-madely given. Don't do this into 1 plus D. No, the answer will be wrong. This itself is the next year dividend only. Then preference stock is redeemable after 10 years and is currently selling at 95 rupees per share. So with respect to preference shares, what they have given? They have given the life of the preference shares. Yes, life, which means redeemable preference shares. Correct or not? Yes. Now, what are they given? The currently it is selling at how much? 75 rupees, which means today if I raise the money through the preference share mode, I will get a net proceed of how much? 75 rupees. Any flotation cost given? Nothing has been given. Are you clear with this? Then I also need the redemption value in the absence of information. Nothing is mentioned. You can assume it as redeemable at par. And what is the par value? 100 rupees. Are you clear with this? So if I issue today, I will be getting 75 rupees, which is the net proceeds. Redemption value is going to be how much? 100 rupees. Preference dividend, we know it is how much percentage? Preference dividend is 11%. All this data we have. So with this, we can easily calculate it. Are you clear with this? Then debentures redeemable after 6 years are selling at 80 rupees per debenture. So now for debentures also they have given the life. What is the life? 6%, which means what? Finite life, redeemable debentures. So now net proceeds for debentures is going to be 80. What is the redemption value, redeemable or redemption value? Nothing has been mentioned. Assume that it is going to be redeemed at par. Are you clear with this? Don't question the question further. Whatever is the data given, that alone you use. Any other data not given, you can take a fair assumption, and in this chapter these are the fair assumptions that are allowed. Are you clear with this? Learn the rules of the game. Next, the income tax rate for the company is given as 40%. This is what they have given. Income tax rate for the company is only given, which means there is no personal income tax rate. Are you clear with this? So in this case, retained earnings and all, KR is equal to KE, directly you can do. Are you clear with this? So this is what is the present data given in the question. Required, calculate the weighted average cost of capital using book value proportions and market value proportions. Sir, in this question, market value is not given. Who said it is not given? For respective, they have given you the market price per share. Equity shares they have given, preference shares also they have given, debentures also they have given. So multiply the market price per equity share into number of shares, market price per preference shares into number of preference shares, then market value of debentures into number of debentures. You will get the market value and use that as a weight to again compute your weighted average cost of capital. Are you clear with this? So it need not be separately given in the tabular format. Using this also you can compute the market value weights. Are you clear with this? Yes. Then the second part of the question is what we are going to learn something new here in this question. We are going to see something new in this question. Of course, we have learned all these things in our regular classes, but yes, we are going to revise it for the first time in this marathon. Now, define the weighted marginal cost of capital schedule for the company if it raises 10 crores in the next year, given the following information. Now, what they are saying, this additional information is not for this data. They are saying the company currently has 15 crores equity, 1 crore preference, 20 crores retained earnings, 10 crores debentures, 12.5 crores term loans. Correct? This is what the company has. For this, you compute weighted average cost of capital. Right? That's about it. Now they are saying the company is planning to raise 10 crore rupees more. Further, they are going to raise how much? 10 crore rupees. Correct? They are going to raise 10 crores. And this 10 crores, how it will be raising this, given the information, the amount will be raised by equity and debt in equal proportion. This amount is not there in the books. Newly they are going to raise. Are you clear with this? So for the 10 crores they are going to raise, they have given the following data. Amount will be raised by equity and debt in equal proportion. The company expects to retain 1.5 crores earnings next year. The additional issue of equity shares will result in a net price of share being fixed at 32. So for the purpose of fresh issue, the cost, that is the market value of equity share will be taken as, the P0 will be taken as 32. The debt capital raised by way of term loans will cost 15% for the first 2.5 crores and 16% for the next 2.5 crores. Define the weighted marginal cost of capital. Meaning what? Marginal. What does this word marginal stand for? Marginal means incremental. Marginal costing. Yes. So marginal means what? Incremental. So for this extra 10 lakhs, the 10 crores that I'm going to raise, what is going to be my weighted marginal cost of capital? Is this entire 10 crores going to come from one source like equity or debt? No. Equity, debt, there are so many combinations there. So for this extra 10 crores, what is the weighted marginal cost of capital is the calculation that is done in the second part of the question. Are you clear with this? First, let us do the first part. For the second part, you should use all this data. Now, first, forget the second part. Using this data, let's do the first part of the question. And once we are done with that, we can move to the second part of the question. Are you clear with this? So broadly, this is a chapter all about calculation of WACC and weighted marginal cost of capital and each of the components calculation. This is the overall chapter's entire concepts involved here. So now let's get started with the first part of the question, wherein they've asked us to calculate the weighted average cost of capital using the book value weights, market value weights. Now, when we have to compute the weighted average cost of capital, you can't jump to the question directly. What you need to do, component wise cost we need to calculate. Correct or not? Yes. So now first, part 1 is weighted average cost of capital. Part 2 is what? Weighted marginal cost of capital. We will come to that in a few minutes from now. First, calculation of KE and KR. Why have they merged KE as well as KR? Because KR is always equal to KE. Only if those two exceptions apply, KR calculation should be done separately. In this case, you tell me for KE calculation, do we use any flotation cost and all? Nothing we are using. Correct? It is not a fresh issue. It is a present equity share only. Correct? And is there any personal income tax or brokerage given in the question? No. In this case, automatically KR will be equal to KE. Yes. So automatically, once you calculate KE, you can use that also for saying, you can use that and say that that is also your KR. Are you clear with this? Yes. Now, KE, how will you calculate which formula? There are so many formulas like CAPM formulas, you have your IRR formula, you have your constant dividend formula, your constant earnings formula, dividend growth rate, constant your dividend growth rate, earning growth rate. There's so many formulas here. Which formula we are going to use here? Very clear with the wordings of the question. So they have given the next expected dividend growth rate and all, and the present value, the present market price per share. So it's clearly your dividend growth rate model, Gordon's model in that dividend growth rate. So basically the formula that we'll be using is K is equal to D1 by P0 plus G. Correct or not? Yes, D1 by P0 plus G. Yes. Now this is for the present equity shares that we have. Yes, guys, are you clear with this? So now what is D1? 3.6, correct? What is P0? 40, and what is G? 7%, correct or not? So 3.6 upon 40 plus 0.07, 3.6 upon 40 is equal to 9% plus 7%. That gives you how much? 16%. So KE is equal to KR is equal to 16%. And in this case, KE is equal to KR because those two exceptions are not applicable here. If they had given flotation cost and all these things, or if they had given that for fresh equity shares that newly issued and all these things, then yes, KR calculation should be done separately. Or if they had given brokerage or personal income tax, then you need to do it separately. In this case, no such thing is given. So basically, the cost KR is equal to the cost of existing equity shares. We know that. Are you clear with this? So automatically you can take this. Why the logic and all we saw? Because KR is nothing but cost of retained earnings. Retained earnings also belongs to the equity shareholders. So KR is equal to KE. Next, calculation of KP. Now look at this calculation of KP. Now, what is it they have given in preference shares? The preference stock is redeemable after 10 years and is currently selling at 75 rupees per share. This is what? Redeemable preference shares, which means redeemable preference shares or redeemable debentures, redeemable preference shares and all. You have two ways of arriving at the answer. First method is IRR method. So what you will do, frame the cash flow equation, take randomly, you should take two trials. 10%, 12% or 10%, 15% or whatever it is, you will take two trials. One will have a positive NPV, one will have a negative NPV, interpolate and get the answer. That is a trial and error method, IRR method. Or the second method is what? Shortcut method, correct? The formula approach. Yes. Now, what is the formula to calculate your KP? So, come on. You tell along with me. Logically think and you tell along with me. In case of preference, so in the numerator, you should have the cost, right? So what is the cost? You have preference dividend plus RV minus NP divided by N, the whole by RV plus NP divided by 2. Yes or no? Yes or no? Yes. So now preference dividend. How much is preference dividend per share? How much is it? So preference dividend is given as how much? So it is going to be 11%, correct or not? So 11% on 100. So every share, the dividend amount is going to be 11 rupees, correct? It's going to be 11 rupees plus redemption value. Redemption value, how much is it? It is not given the question. See, it is redeemable after 10 years, currently selling at 75 rupees. So the net proceeds is how much? 75. That is, if I raise today, I will get 75 and I need to redeem it at what? Nothing is given. So you will redeem it at par. Are you clear with this? So RV is 100 and NP is going to be 75 rupees. So look at this. RV is 100 redemption value minus NP net proceeds is 75 divided by the life of this particular preference shares divided by 10, the whole divided by RV plus NP by 2. So 100 plus 75 by 2. Are you clear with this? So I am issuing it at 75, redeeming it at 100, which means I'm paying 25 rupees more. That is the cost I incur extra. Yes, but that is a cost pertaining to 10 years. How much is the cost pertaining to 1 year? That's why we have done. So 25 divided by 10. Are you clear with this? Because this 11 is also an annual cost. So you should only have an amortized annual cost for this redemption extra amount that you are paying. Are you clear with this? And then will you take the redemption value or the net proceeds? Take a simple average of 2. So now tell me how much is this going to be? So this is going to be 13.5 in the numerator. So 175 by 2, that's going to be 87.5. So 87.5. So this is going to be 15.4285%, round it off to 15.43%. Are you clear with this? Yes. Now rounding off again, many students have some doubt. Sir, how can I round off? As in, so should I stop at 2 decimals or should I retain all the decimals? I would suggest you at least have 4 decimals generally in this sum. Yes, it is solved like this. Generally, it is better to have 4 decimals. It is always better to have. It's a global policy. That's what people generally follow in the world of finance. They take 4 decimals. So generally take 4 decimals. 3 or 4, preferably 4 decimals you take. Yes, and then you can actually calculate. But rounding off should be done. Even this 4 decimals round off. I'm telling you to stop at 4 decimals. That can be done only the final step. That is at the time of calculating the cost of that particular source of finance. In between and on, you don't round off anything. Finally, for KP or KD, the final step, yes, you can round off and keep it as 4 decimals. Are you clear with this? So if you round off, if you take only 2 decimals or if you take 4 decimals, between these two answers, there will be a slight difference in the overall answer. Weighted average cost of capital, yes, rounding off issue will always be there, so don't worry about it. For that, marks will not be reduced. Understand, this is more to do with conceptual clarity and the way you solve it. So the decimals and all, I'm telling you, you take a policy. You tell yourself that for all the sums I'm going to take 4 decimals. You follow it throughout the exam paper. You follow 4 decimals. It's absolutely fine. In certain questions, they themselves will give you stop at 3 decimals. Then you follow whatever is given in the question. If nothing is given, you can take 4 decimals and you can leave it there. Are you clear with this? Yes. Next, calculation of KD. Now, look at this KD. Debentures are redeemable after 6 years. So this is also what? This is also a redeemable debentures. So in case of redeemable debentures, there are 2 ways of computing the KD. One is your IRR method. The other one is a shortcut formula method. So what is the formula for calculating KD? Now look at this. They are redeemable after 6 years and are selling at 80 rupees per debenture. So if I raise today, the net proceeds will be 80 rupees. No flotation cost and all. Nothing has been given. Why? Because nothing is given, so you can take it as 0. Then redemption value silent, so you will assume that it is redeemed at par. Are you clear with this? And what is the interest rate on debentures? It is going to be 13.5%. Are you clear with this? So now, what is going to be the formula for calculating KD? Come on, guys, tell me. So KD is equal to, yes, I into 1 minus T. Correct? Always remember, interest outflow is when I pay interest, I will get a parallel savings of tax. So the net outflow will only be I into 1 minus T, correct? Plus RV minus NP divided by N. In this case, the life is 6 years. The whole divided by RV plus NP divided by 2. Are you clear with this? Logically understand, and as simple as that, you need not do anything else. You just need to remember this conceptually. Any kind of sum you can tackle by yourself. So now, tell me what is the interest here? 13.5 rupees into 1 minus 0.4. So the tax rate is given as 40%. So 1 second, where is it? Yes, the tax rate is given as 40%. Correct? So now look at this. So 13.5 rupees into 1 minus 0.4 plus redemption value 100 minus net proceeds 80. So extra I am paying them how much? 20 rupees. 20 divided by 6. Correct? Life of the asset. The whole divided by 180 plus 80 divided by 2. So finally you get how much? You get 12.7% as your KD calculation. Are you clear with this? Are you clear with this? Yes. So now this is also done. So KE is done. KP is done. Yes, K is equal to KR. So KR is also done. KD is done. And finally, KT we need to calculate. What is KT? Cost of term loans. Very simple. There is no concept of your net proceeds or redemption value or not. Always, when it comes to term loans, it is just a question of your principal and repayment of interest. The only cost associated to it is interest. But wait, this interest is also tax deductible. So KT is equal to interest rate into 1 minus T. Directly you can do. So 15% into 1 minus 0.4. Are you clear with this? So KT is going to be 15% into 1 minus 0.4. That is going to be 9%. Yes. So now we have all the figures with us. We have all the sources of finance, all the costs of each and every source of finance. So now let's directly jump to what? Calculation of weighted average cost of capital using book value weights. So if this sum comes, it will come for a 10-mark question because it's a completely comprehensive question. Even the previous question, if it comes, it will come only for 10 marks. Even if this comes, it can come for 10 marks. Are you clear with this? Yes. So now look at this. Now, so cost of equity, preference, debentures, retained earnings, and loan. Now, first, let us take the book value of each and every component. Book value is a given, yes. 15 crore, 1 crore, 20 crore, 10 crore, and 12.5 crores. Correct? So you just put it here. 15 crore, 1 crore, yes. 10 crore, 20 crore. So debentures and then retained earnings and then loan they have given 12.5 crores. Overall, if you do, it's going to be 58.5. Calculate the weights. 15 divided by 58.5, it's going to be 0.256. 1 by 58.5, 0.017. Then 10 by 58.5, it's going to be 0.171. 20 upon 58.5 is going to be 0.342. Then 12.5 upon 58.5 is going to be 0.214. And this is overall weights. If you add up, it will obviously equal to 1. Are you clear with this? Now, component wise, we have the cost, correct? What is KE? So KE is going to be how much? KE is going to be 60%, 16%, correct? So 16% is the cost KE, and remember the same KE is equal to KR in this question. So KR also you can fill up the 16%. Next, KP. What is KP here? So KP we have calculated it 15.43%. KP is going to be 15.43%. Then debentures KD 12.7%, 12.7%, and KT, the cost of term loan, is going to be 9%. Are you clear with this? So multiply the weights with the respective cost. So 0.256 into 16% plus 0.017 into 15.43%, and so on. You multiply the weights with the cost. Overall, you get 13.928. This is your overall cost of capital under the book value weights. Are you clear with this? Are you clear with this? Yes. Now, similarly, you need to redo this calculation of WACC using market value weights. Now, can we do this? Yes. Again, equity, preference, debentures, loan. I told you, there are two ways in which you can do this. So, the market value of equity, you can just take it as market value of equity, and under retained earnings you can put it as 0, or the market value of equity can be split between the equity share capital and retained earnings in their book value proportions. Are you clear with this? In this sum, just like the previous sum, we have taken the entire value of equity. We have taken the entire market value of equity and put it under the equity share capital only. Are you clear with this? Yes. So now, first let us compute the market value of every source of finance. The first one, the market price per share is how much? It's given as 40 rupees, correct? Now, how many shares are there? So, look at this, 15 crore divided by 10. So, 1.5 crore shares are there into 1.5 crores into 40. So, 1.5 crores into 40, how much is that? 60 crores is the market value of equity. Are you clear with this? 60 crores is the market value of equity. All these rupees are in crores. They are in crores. Are you clear with this? Second, let's go for preference shares. So what is the market price of preference shares? 75 rupees. Are you clear with this? They have given it as 75 rupees. Now, how many preference shares are there? So the preference share capital, currently the value is 1 crore divided by 100. So 1 crore divided by 100. 1 crore divided by 100 into that is 0.01 crores into. So what is the current preference share value? It is going to be 75, correct or not? Yes, into 75, it's going to be 0.75 crores is the market value. So this is what? This is the number of preference shares. So how can it be in decimal? Wait, this is not decimal. 0.01 crores, which means 1 lakh. Are you clear with this? 0.01 crore is nothing but 1 lakh. 1 lakh preference shares into 75 rupees per share, 75 lakhs. That's why you get an overall of 0.75 crores. 0.75 crores is nothing but 75 lakhs. Are you clear with this? So you get a market value of how much? 0.75 crores. Are you clear with this? Yes. Then debentures. What is the market value of debentures? The market value of debentures, look at this. Currently the debentures are selling at how much? 80 rupees per debenture. So what is the total number of debentures? 10 crores divided by 100. So 10 crores divided by 100. Currently you have 0.1 crore, that is 10 lakh debentures you have. And every debenture is having a market value of 80. Are you clear with this? So overall, the market value of debentures is going to be 8 crores. Guys, are you all able to understand? 0.1 crores means what? 10 lakhs. 10 lakh is the number of debentures. Every debenture has a market value of 80 rupees. 10 lakh into 80 is how much? 800 lakhs, or in other words, it is 8 crores. Are you clear with this? And the market value of debentures is how much? 8 crores. Are you clear with this? Yes. Then finally, the market value of loan. Now, loan does not have a separate market value and all. Whatever is the book value, that is only the market value. Because if you see, there is a debt market in which debentures will be traded. Are you clear with this? There is an equity market in which your equity shares can be traded. Even preference shares are listed and they can also be traded. Whereas term loans cannot be traded separately and all. It is between the bank and the particular company that has borrowed the money. That's about it. It does not have a ready market value. Always remember, for term loan, the book value is equal to market value. Market value separately is not there. Whatever is the book value is the market value. So take it as 12.5 crores. Are you clear with this? Take it as 12.5 crores. So now this totals up to how much? 60 plus 0.75 plus 8 plus 12.5, that gives you how much? 81.25. Calculate the proportions. 60 upon 81.25 gives you 0.738. 0.75 divided by 81.25 gives you 0.009. 8 upon 81.25 gives you 0.098. 12.5 upon 81.25 gives you 0.155. That gives a total weight of 1. Now, what is the respective cost of capital? Yes, the respective cost we already know. Equity it's 16%, preference 15.43. Yes, you can copy paste the figures from here. Debentures 12.7. Then retained earnings, not a separate line item because it is already included in the value of equity. Are you clear with this? Because we have taken market value weights here. So market value of equity includes what? The market value of equity share capital plus the market value of retained earnings. Are you clear with this? Then loan is 9%. So you multiply the weights with the respective cost. So if you compute the weighted average cost of capital from the market value weights perspective, you will get KO as equal to 14.587%. Are you clear with this? And with this, we have finished the first part of the question, that is calculation of weighted average cost of capital using book value weights and using market value weights. Are you clear with this? Yes. Now, let's go to the second part of the question. And in the second part of the question, remember, for the second part, the first part was what? The company already has the sources of finance for which they have given all the figures and they have computed. Now they are saying define the weighted marginal cost of capital schedule. So define the weighted marginal cost of capital schedule means what? Define means it is not a definition. They are asking you for the schedule. What is the schedule? I will tell you now. If it raises 10 crores next year, following is the information given below. The amount will be raised by equity and debt in equal proportions. Now wait, the company is going to raise how much? Now let me just put it here. Yes, the weighted marginal cost of capital. The company is going to raise how much? 10 crores. Correct? Yes. Read line by line. The amount will be raised by equity and debt in equal proportion. So the company is going to raise 10 crores. So which means out of this, from the equity channel, the company is going to raise how much? 5 crores. And from the debt channel, the company is going to raise 5 crores. How do we know? Exactly 50-50. That is what is given here. Correct or not? Yes. Now, the company expects to retain 1.5 crores earnings next year. So what they are saying is retained earnings which will be used for funding this extra 10 crores is how much? So they are saying the retained earnings that will be used for this particular funding is how much? It is going to be 1.5 crores. So retained earnings comes under the equity component only. Correct or not? So which means what? The remaining 3.5 crores of the equity component will come from new equity shares. So new equity shares will have to be issued to the tune of 3.5 crores. How do we know this? This is the balancing figure. Pencil circle balancing figure. Out of the 5 crores equity component, 1.5 crores will come from retained earnings, which means the balance 3.5 crores will be coming from what is the source of finance? Equity only. So obviously retained earnings to the extent of 1.5 only it is available, which means the balance 3.5 will have to be necessarily issued as a fresh equity capital. Are you clear with this? Yes, then. The additional issue of equity shares will result in the net price of share being fixed at 32. So for this fresh issue, the share price will be fixed at 32 rupees. Then the debt capital raised by way of term loans will cost 15% for the first 2.5 crores and 16% for the next 2.5 crores. Interesting. Now this debt of 5 crores is given in the question, right? This debt also, it is not like entire debt of 5 crores is having one cost. They are saying there are two different types of debt. Here if you see, there is 15%. What is this? A debt model they have said? Term loans. So 15% term loans will be 2.5 crores and the balance 2.5 crores will be having how much percentage? Will be having 16%. This is what is given in the question. So basically the next 10 crores, what is the source of finance? 1.5 crores from your retained earnings, 3.5 crores from issue of fresh equity share. This is not existing equity share, fresh equity share, which means what? You need to recalculate for the fresh equity shares. You need to calculate the KE once again. Are you clear with this? That KE was for the current equity share. This is for what new equity shares you're going to issue. For this, the market price is different. So once again, you need to recompute the KE for the purpose of this fresh issue. Then there is 15% term loan for 2.5 crores, 15% term loan for 15% term loan for first 2.5 crores, 16% term loans for the next 2.5 crores. Are you clear with this? This is what we need to compute. So what we need to do here, For each of these source of finance, we should now compute the cost and then multiply it with the respective weights. You will get the weighted marginal cost of capital. That is, we are computing the cost of this extra 10 crore rupees. We are not at all talking about the current cost of capital. Extra, for the extra 10 crores, overall what is the cost? See, to the extent of 1.5 crores, the cost is different. For this 3.5 crores, the cost is different. For 2.5 crores, the cost is different. And the next 2.5 crores, the cost is different. Overall, for the 10 crores, what is the weighted marginal cost of capital? Why marginal? Because it's a new amount that you're going to raise. Fresh amount you're going to raise. Are you clear with this? Yes. So now, let's get started with this. So now, look at this. So first, this is what they have given. And this question they have asked you, right? Define the schedule they have given. Correct? So read the question. Define the weighted marginal cost of capital schedule. This is only called as the weighted marginal cost of capital schedule. So what is the schedule in which, how are they going to raise the funds? This is how they are going to raise the funds, and this is only called as schedule. Are you clear with this? Or you can also put it in a line by line format as given in the question. Equity is 5. So from this equity, share capital is 3.5, retained earnings 1.5. That is what we did. 1.5 crores is retained earnings, 3.5 crores is equity shares, new equity shares. Then debt is 5. In that 15% term loan, 2.5 crores, 16% term loan is 2.5 crores. Sir, in exam, can I put it in this flowchart format? Absolutely yes. No problem at all. You can definitely do it like this. They will not reduce any marks. Are you clear with this? But make sure that you are writing TL and all. You don't write it as term loan. Just make sure that you're writing it fully. That's about it. But definitely you can use this. Yes, you will have complete grip over this particular area. Now, what we need to calculate? First, for this new equity shares, we need to calculate what? We need to calculate KE. Correct? Yes. So now, what formula will you use? Now, look at this. Look at this. The additional issue of equity share will result in the net price of share being fixed at 32 rupees. Now, in this question, they have given initially itself the dividends are growing. Correct? So, KE is equal to D1 by P0 plus G. Correct or not? Yes. Now, in this question, do we have D1? The next year's expected dividend is 3.6. Yes. Can we use that? Yes, because for all the equity shares, the present as well as for the new equity shares, the dividend rate will be the same. 3.6 divided by P0, the amount that I'm going to raise today, the present value of all the equity shares is going to be how much? 32. With respect to the fresh equity, it's going to be 32. This is different. Are you clear with this? For this equity shares. Plus G, yes, the growth rate will be same for all the equity shares issued by the company, which is 7%. Are you clear with this? 0.07. So in this case, PO alone changes, and because of that, KE for the fresh equity shares will change. Are you clear with this? Are you clear with this? So that means 3.6 divided by 32 is going to be 11.25% plus 0.07, right? 0.07. Yes, it's going to be 18.25% is going to be the cost of fresh equity shares. Are you clear with this? And that is what is being done here in this area. Look at this. D1 by P0 plus G, 3.6 upon 32. This 32 is the your P0 or the present market price, the net proceeds of the fresh issue. Are you clear with this? Plus 0.07. It's going to be 18.25. So this D1 and G we have taken from the first data. Sir, how we can take from the first data this alone? Yes, because for all the equity shares, the dividend will be paid alike. I cannot say, okay, now I have issued fresh equity shares. For this equity shares, I will not pay dividend. For the existing shares alone, I will pay dividend. No, you cannot do this. Your company law does not allow it. For the existing or the new equity shares, the dividend has to be alike. There cannot be any discrimination between the shareholders. Are you clear with this? So that is the reason we are doing it. So the growth rate and dividend and all will be the same, whereas what changes is only P0. Are you clear with this? Yes, because of the change in PO, the KE for the new capital is going to be different. It's going to be 18.25%. Now, very interesting. What will be KR? What will be KR? I said KR will be equal to KE of existing share capital, of existing equity shares, and I told you KR is not equal to KE of new equity shares. Correct or not? Now in this case, KR is equal to how much? It is not 18.25. Why? Because 18.25 is the KE of the new equity shares, whereas For the purpose of taking KR, I will go to my first part calculation. I will take it as 16%. Sir, why is it 16%? Because with respect to KR, it is only the KE. KR is equal to KE of existing equity shares. I am not issuing anything afresh. I already have the money in my bank account. Are you clear with this? So here the fresh price or the flotation cost and all should not be considered. So it continues to be 16%. Very, very important. Again, time and again students make a mistake here. Time and again students make a mistake here. So KR is equal to 16%. Are you clear with this? As simple as that. As simple as that. So now new KE is going how much? So now 18.25, correct? So now the new KE is going to be how much? K is equal to 18.25. We just calculated. KR is equal to how much? 16%. Huh? We just saw 16%. Yes, 16%. Now KT is going to be how much? Cost of term loan. Very simple. The interest rate into 1 minus T. So for the first 2.5 crores, 15% into 1 minus 0.4, which is equal to 9%. So for this, the KT is going to be 9%, and here it's going to be 16 into 1 minus 0.4, which is going to be 9.6%. It is going to be KT is equal to 9.6%. So now for the extra capital of 10 crores, you know what is the amount from each source, and you also know the respective costs associated with it. You just need to weighted average, and whatever answer you get is the weighted marginal cost of capital. This is the new capital, marginal, incremental capital. Are you clear with this? Yes. So directly now you can go and compute the weighted marginal cost of capital. Equity, retained earnings, 15% term loan and 16% term loan. Equity is how much? 3.5 crores. Retained earnings, 1.5 crores. Term loan is going to be 2.5, and 15% term loan is 2.5, 16% term loan is 2.5. The weights will be 0.35, 0.15, 0.25 and 0.25. Cost will be what? Equity, cost of equity is 18.25. Very, very important. That's why I marked it in red ink. Cost of retained earnings, KR is equal to KE of existing equity shares. I told you the two exceptions. You remember? See how beautifully they have applied it and asked in this question. It is going to be 16%, not 18.25%. 16% is what the KE of the existing equity shares. Are you clear with this? Term loans is going to be 9%. 16% term loans is going to be 9.6%. So multiply the weights with the cost. 0.35 into 18.25 gives you 6.3875%. 0.15 for 16% gives you 2.4%. 0.25 into 9 gives you 2.25. 0.25 into 9.6 gives you 2.4%. So for this extra 10 crores that you are going to raise, overall weighted marginal cost of capital is going to be how much? 13.4375%. So basically for the extra capital that I'm going to raise, this is the overall cost for the next 10 crores. Then, sir, what was the weighted average cost of capital? This 13.928 and this 14.587 and all. This is nothing but the cost of capital for the existing capital that I already have. Are you clear with this? That's why it's called as weighted average cost of capital. Whereas the second part is called as weighted marginal cost of capital. So marginal means the incremental. So for the extra amount that I am going to raise, for that, whatever is the cost is what is being mentioned here. Are you clear with this? So with this, all the major and important concepts of this particular chapter are over, right? So now please revise this chapter once so that you get a conceptual clarity, and please, for God's sake, don't ever mug up any formulas. Learn it conceptually, and automatically in the exam hall, on the spot, you will be able to write the formulas all by yourself. You need not mug it up. You can automatically say the logic behind every formula. That's how you should learn this particular subject. If you mug it up, then obviously you won't know what to apply, which method to apply in which scenario. Are you clear with this? So for you to get a complete control over this subject, it is purely conceptual based understanding. That's how you need to learn the subject. And I've taken two comprehensive questions. And sir, is this all that is present in this particular chapter? Predominantly, yes. But there are so many other things. There are so many other concepts also in this particular chapter, like so many adjustments, small adjustments. But predominantly for the revision purpose, overall, this covers a predominant portion of this particular chapter. So with this, let us move to the next chapter.